I would not be outright short risk.
Stay invested. Don't try to time this market.
It's a little bit of a high convexity trade still.
The market isn't necessarily going in and rewarding everyone.
We still think the broadening story is happening.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, extending gains. Tech stocks looking to add to a 5-week winning streak as the White House is outlining vague plans to help some ships exit the strait. The Treasury is insisting that Iran's energy industry is at breaking point. Crude inching high this morning.
So the Treasury Secretary said next week we could see shut-ins when it comes to Iranian oil wells. But 2 weeks ago, he said it was just a matter of days. So this story just continues to linger. And while the president, Jonathan, put out this Truth Social post yesterday afternoon saying that they are going to start guiding ships through the Strait of Hormuz, immediately at the open, you saw oil fall. But then there was a Wall Street Journal report saying that actually this isn't going to be naval guides. This is more electronic guiding. And that's why you see basically we're back to square one and nothing has really changed on the ground.
The hopium doesn't bite in quite the same way. I was watching the golf yesterday. The president was attending the Cadillac Championship. Cam Young wins by 5-6 shots, something like that. And then the president hits send on social media. I'm not sure it's playing out in quite the same way.
So basically that optics doesn't really work. If you're at the Gulf, how can you actually maybe be directing the guidance of the Navy's 5th Fleet into making sure these vessels come safely out of the Strait of Hormuz? Maybe it's not working, but at this moment, they are still in this mode of trying to move, at least through humanitarian effort, some of these vessels out electronically. I think the proof is in the pudding. We have to see if any of these vessels are able to escape. And on top of that, the president also said in this post that they are having positive discussions, his representatives, with the Iranians. Do we believe it? Again, proof in the pudding.
We've heard that a few times too, so let's just go through the 3 options. They haven't really changed. Maintain the blockade, resume the bombing, walk away. Said this repeatedly over the last week and can change really quickly, but for now, the administration seems pretty comfortable with option number 1, maintain the blockade.
Yes, and the Treasury Secretary said yesterday that they are running a marathon over the past 12 months, and now we are sprinting towards the finish line. They are not able to pay their soldiers. This is a real economic blockade. They think the blockade is working, and it is working. Iran's economy right now is in dire straits. But does it mean that we are going to see them collapsing within the next days or weeks that this administration continues to promise? I'm not sure we're there yet.
Let's talk about the week ahead. Last week full of earnings. This week full of economic data. The big one on Friday, payrolls Friday. The estimate in our service, 65K. It's the data and some Fed speak that matter this week.
Absolutely. The data is going to matter, especially to the financial markets, given the fact that where does this Federal Reserve sit right now? We heard from Neil Kashkari over the weekend, basically saying that right now, when his a little bit more of a hawkish tone, is because potentially what's going on in Iran, Jonathan, could a hike at some point when it comes to this economy.
Futures turning lower just seconds ago. We're negative on the session now by about 0.1%. Coming up this hour, we'll catch up with Altmann of Barclays, with stocks looking to add to record highs. Roule of CSIS with the US set to guide ships through the Strait of Hormuz. And Aditya, Bhave of Bank of America looking ahead to the payrolls report. We begin this hour with global stocks holding steady, with tech leading the way. Altmann of Barclays writing, until positioning gets more full, it is hard to position bearish even after this rally. Alex joins us now for more. Alex, good morning.
Good morning.
Good to see you. Before we talk about irrational or rational, let's talk about exuberance. Where are you seeing exuberance at the moment?
Honestly, not that many spots. I suppose we have to gravitate towards the semiconductor index. That would be one place that I would say the word exuberance in semiconductors after a blistering 50% rally has sort of become conjoined. But actually, if you look beyond just the price action itself, look at the number of constituents within the semiconductor index that are seeing call vol above put vol, i.e. you're seeing a demand for that right tail. It's just not there, not even like it was earlier in the year. So, and then look at things like Bitcoin, still down on the year. And then actually look at headline indices. Yes, they're up, but actually year to date, it's relatively modest. So people, I think, have become very focused on the path to get here and the velocity rather than actually necessarily taking stock of where we are.
So what's your message to people who are looking at this and they've missed it? The 50% move off the lows that we've seen on, say, chips, the rally we've seen, double digits on the S&P 500, a little bit more on the NASDAQ 100. What's your advice to those people?
OK, so I think there's two things. First of all, I think we have to work off the assumption that clearly the pace we've just seen over the past month is non-repeatable. We had the 27th best month in the S&P since 1928. It was the second best April ever. So I think we have to work off the assumption, moving back to a more normalized pace of S&P returns, something along the lines of, I call it 1% a month is kind of where your average is. S&P goes up on average 73% of the time on a sort of forward 1 to 2 month basis. So that's kind of what we've got to work off. The other thing is we've got to work off asymmetry. Like the market is no longer asymmetric like it was as we were advocating in March and April. Right now, I think our forecasters, Barclays research is around about 7,600. So you've still got a little bit of upside, but at the same time, we have to work off the assumption there is back to a negative decay for risk assets, i.e. the longer this goes on within the Straits of Hormuz, the more problems we're now going to face. A lot of the buffer that we had in place going into this debacle is now going to get eroded. So if this is still dealing with this blockade at the end of May, then I think we have to work off the assumption the symmetry of risk doesn't look very good.
Things are starting to change, and we noticed this catching up with a few individuals from the research team at Barclays. It's not that the situation in the Middle East didn't matter, it just didn't matter yet. Are we getting closer to that point now, then?
We are, yes. I mean, you have to work off the assumption, OK, so we've got, what, 22 days of gasoline reserves. We've got a couple of weeks' worth of other distillate reserves. We came in with a huge oil buffer. We also, bear in mind, it takes 3 weeks for a lot of these tankers that already left the Strait of Hormuz to get to where they were going. So, again, are we 8 weeks into this crisis? Arguably, it's more like 5. So as we move through May, we're going to be dealing with bigger problems. And I think we have to acknowledge that, including individuals that have been bullish, such as myself.
So what happens in the reaction of the market at the end of May if this blockade continues and we're still in this impasse?
So if you talk to our oil research, they think that if we're still dealing with the blockade by the end of May, it's going to be another $20 on WTI and Brent. So we're talking about somewhere around about 110 in TI and about 130 in Brent, and that's going to start becoming a problem. You think about the US, we're going to be entering driving season. Think about Europe, obviously. They said 3 weeks ago they were going to run out of jet fuel. Meanwhile, they're still flying planes last time I checked. But you have to work off the assumption that this is going to become more and more a problem, more acute, and it's obviously non-linear as well.
But I mean, what happens to equities?
Oh, without a doubt, equities are going to start to decay again, much akin to what we saw in March. So that behavior in March, you basically had that positive recay from oil and the decay of equities, that will start to re-exert itself. And again, I think we have to acknowledge that.
Starting to see the move in crude this morning. Early days, things can change, but Brent up by more than 3%. Brent back to about 112. As the bond market gets moving, Treasury yields higher at the front end of the curve, up by 5 basis points, pushing 392. Is that becoming a bigger consideration now? The moves we're starting to see once we're on the bond market, retesting and breaking through the highs of earlier this year?
Absolutely. And I think there's two dimensions. Dimension one is the fact that the 30-year got back to 5% and no one mentioned anything. So I think a breach of 5% at the back end, I think, would be a serious problem in that regard. And the second one is we've got to talk about real yields. I mean, Annmarie, you asked about what the impact of equities is. Equities are sensitive ultimately to the real yield trajectory. So if real yields are moving back up as a function of nominal yields and break-evens not moving as quickly, then I think equity risk premium has a problem.
Is this Fed getting closer to hiking?
Well, I would hope that the Fed...
You're not alone with that hope, by the way. I know what's coming.
I would hope that the Fed would take very much from the Greenspan playbook of the early 90s, which is whenever there was an oil shock, Alan Greenspan famously said, "I'm not going to do anything at all, and I'm just going to wait and watch." That is so far what the Fed have said. We've changed as a house our forecast. We're only forecasting one cut in 2027 now. So effectively, the entire curve is assuming that wait and watch scenario. Is there a chance they could hike? There is a chance. Do I think it would be the right thing to do for central bank policy? No, we've all seen what the feedback has been from the ECB recently.
We thought the ECB would learn from Treyz, and now the ECB looks closer to doing the same thing all over again, maybe as soon as June. If you're just tuning into the programme, welcome. Equity futures were slightly positive, then they rolled over into negative territory. Crude started to climb, Brent and WTI. Brent right now up to about 113 and up by 4% on the session. With that move in crude, a move at the front end of the yield curve, two's up by 5 basis points. Let's round this up to 393 on a 2-year yield so far this morning.
So what we're seeing right now, though, Jonathan, is some fresh headlines out of Iran saying they announced a new control zone in the Strait of Hormuz. I think we need to understand exactly what this control zone is, but they say it stretches through Fujairah, which, of course, is in the United Arab Emirates. Maybe this is something that is pushing back on the President of the United States, saying they're going to be able to guide ships actually out of the Strait of Hormuz if Iran is saying, actually, we are going to re-exert that control in the waterway.
This is pretty exhausting stuff. Can you just walk us through how your clients feel about this issue. I know how I feel covering this issue from day to day. What are clients telling you? Are they fatigued, exhausted by it, ignoring it? What are they doing now?
Yeah, I think that in short they are. They're exhausted. I mean, I would give you the most consensus feedback is they're exhausted not having a weekend for the past 2 months. and that really...
Past 2 months, so that's the entire 2026.
I would say that we've crammed an entire year's worth of information into the span of about 4 months. You're absolutely right. But I would say that ultimately is what's keeping a lot of trepidation from deploying risk. Going back to your original point, Jonathan, in terms of how are clients feeling or where's the path of risk, the challenge is that if you're still only deploying, say, 50% of your risk budget or 60, 70% of your risk budget, there's room to clearly grow that in an environment should the backdrop normalize.
But no one wants to be short here, do they?
I would say that people are still looking for interesting ways to hedge their portfolios as opposed to necessarily being short. It's very rare that people actually really lean into a short.
What's an interesting way to hedge your portfolio right now?
Well, actually, you know what? If you actually look at the skew profile of the S&P, because we've rallied so much, skew in the S&P has actually come down a lot. And so actually the put vol relative to call vol in index is actually very attractive right now. So one of the things that we were advocating was actually thinking about the right tail, as in call options outright, as we were moving through March. Now, the smarter trade, I believe, is to actually think about having your portfolio of risk and hedging it with puts. So you're effectively synthetically still long or call, but you actually are hedging the left tail rather than the right tail.
Alex, it's good to see you. Thanks for dropping by. It's going to be a long week again. Payrolls Friday feels a long way away. Equity futures rolling over just a little bit. We're down by 0.4%. Crude higher, bond yields higher too. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. President Donald Trump saying the U.S. will begin guiding some neutral ships through the Strait of Hormuz today. U.S. Central Command saying it will provide military support. An Iranian official posting on X that any U.S. interference in Hormuz would violate the ceasefire. President Donald Trump says he is raising tariffs on cars and trucks from the European Union, claiming the bloc has failed to fully comply with the trade agreement. Trump says the levies will not apply to automobiles built in U.S. facilities. China directing companies to ignore U.S. sanctions on private refiners linked to the Iranian oil trade. China's move testing the U.S. sanction system and coming ahead of a planned meeting between President Trump and China's Xi Jinping. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie a little bit later this hour. Up next on the programme, ready for a deal.
Doing very well with regard to Iran. Again, they want to make a deal. They're decimated. If we left right now, it would take them 20 years to rebuild. But we're not leaving right now.
Up next, we'll catch up with Norman Roule of CSIS, live from New York City this morning. Good morning. Just a little bit of risk aversion kicking in the last 15 minutes or so. Equity futures down across the board on the S&P by 0.5, on the Russell by 0.9. This is the move in the commodity market. Crude higher by close to 5%, 113 on Brent, and yields up across the curve, but particularly at the front end of the yield curve. Twos up by 5 basis points, 393 on twos this morning.
Well, Jonathan, what you see right now in the Middle East is nothing has changed, even though the president has said they are guiding humanitarian vessels through the Strait of Hormuz. Sounds like electronic guiding. This is not a naval escort that many were thinking that the United States did actually years ago in the 1980s. And Iranian media has come out and says they are announcing a new control zone in the Strait of Hormuz. Although the United States remains this blockade that is in place, the IRGC is still in control of the Strait of Hormuz.
You're digging around for details and headlines on that story. We'll get them to you when we see them. Under surveillance this morning, ready for a deal.
Doing very well with regard to Iran. Again, they want to make a deal. They're decimated. It's a very friendly blockade. Nobody's even challenging it. Nobody at all is challenging. If we left right now, it would take them 20 years to rebuild. But we're not leaving right now. We're going to do it so nobody has to go back in 2 years or 5 years.
So here's the latest this morning. The president announcing the U.S. will help ships transit the Strait of Hormuz. Iran warning U.S. forces will be attacked if they enter the waterway. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, President Trump says that these efforts to help guide some commercial vessels will begin today in what is largely seen as a potential test for Iran's grip over the Strait of Hormuz. As we get these new headlines that it appears, according to Iranian state media, that the country has outlined a new map of its control of the waterway. Now, the thing is, we have gotten very little details on exactly what President Trump's operation that he has dubbed Project Freedom will entail, though he says that it extends to neutral vessels that are, quote, victims of circumstance. According to CENTCOM, what is being known as the Enhanced Security Area has been established for coordination, and that the U.S. military is going to allocate guided missile destroyers, aircraft, and drones to the efforts. But the Wall Street Journal reported earlier that as of now, the plan does not include actually having naval warships escort the tankers. It comes amid very little public movement, at least towards a diplomatic deal to reopen the strait, though President Trump does maintain that progress is being made in private. And we did hear from Iranian state media over the weekend that the country was reviewing the U.S.'s response to its proposal that was put on the table and would seek to postpone any talks about its nuclear program, something considered to be a non-starter for this White House. But, John, over the weekend, President Trump didn't rule out the potential that he could restart military strikes in order to get the ball moving when it comes to negotiations, though the administration says for now they are going to keep up that economic pressure.
Tyler Kendall with the latest in Washington. Tyler, stay close. Norman Roule of CSIS writing the following: there is still no evidence that either Washington or Tehran is prepared to make the concessions necessary for a near-term settlement. Norm joins us now for more. Norm, welcome to the programme. Things feel a little bit tense coming into this week. How fragile is this truce still?
Good morning. Well, we have two countries that are each uninterested in starting hostilities, but neither are interested in making the concessions that would bring about a settlement. As I mentioned earlier, the peace talks do remain ongoing, and that is a good thing and are likely to continue. And I think what we're watching with Washington with the Project Freedom is to test the environment to see how far Iran is willing to go to change the atmosphere of the region. So the next couple of days will be quite important.
But Norm, Project Freedom, it sounds like electronic guiding of ships through the Strait of Hormuz. Is that actually possible? Do these ships actually need a naval escort?
Well, they don't need a naval escort per se, but just because we're providing electronic guidance doesn't mean that we wouldn't be also having radar, having perhaps air surveillance. And if they were to come under attack, that doesn't mean that we wouldn't be able to provide assistance if that decision were to be made. And we would be able to do so, but presumably from aircraft, for example, if that were needed. Now, when you're talking about how the ships are moving, it's conceivable that they could be moving through Omani waters. So let's pull this issue apart. We've watched the Iranians in the last few weeks use their own waters to move ships from the north of the Persian Gulf to Pakistan. It could be that what is being considered is just to allow ships to move through Omani waters through the Strait of Hormuz and then to exit through the Arabian Sea. So in essence, it's a reverse of what the Iranians themselves are doing. And then if the Iranians were to attack, they would be in essence attacking into Omani territory. The Omanis would have given the U.S. permission to conduct operations. We would be providing defensive support. All of that would be legal under international law. So again, that is a hypothetical scenario, but that is something that might be possible.
Iran this morning is announcing a new control zone of the Strait of Hormuz. Is there any evidence that they're going to allow the U.S. to have such operation?
Well, there's no evidence that the Iranians are going to say anything that the U.S. will care about. I mean, the Iranians are going to make a number of statements exerting their control over the Strait of Hormuz, but the U.S. doesn't recognize that because they have no legal authority to control an international waterway. So this is just another statement by the Iranian government, and their parliament has made a number of statements making such claims. So this is just one more in a long line of such statements.
Norm, when do you think the Iranian oil industry will start to see shut-ins and really be forced to potentially have a little bit more of an economic collapse in the oil industry? The Treasury Secretary yesterday said next week, although 2 weeks ago he said it was just a matter of days. We are seeing the Iranians use alternative routes like putting some oil by rail to China. At what point do you think we see really economic collapse?
Well, we're certain that this Treasury Secretary was correct. Within some days, the Iranian system was facing severe problems. They started to use old ships that they had in storage to store oil. And they are indeed sending some oil out through land routes through Pakistan reportedly. But this does not relieve them of their problem. But the question really becomes that once they start shutting oil fields, does this really change their decision making? And so there's a question of, or will they feel economic pain, and will the pain be sufficient to actually matter in terms of the diplomatic negotiations? So yes, they will start feeling pain, significantly increased, probably in about a week to 2 weeks, but it's going to be some time after that before they actually reach a point where it starts to degrade IRGC, Revolutionary Guard operations, and government operations to the point where the government feels they have to make changes. That could be some time. But we should be upfront. The Iranian government is losing hundreds of millions of dollars a day because of their decision making, and that is certainly impacting the debate within their decision making. However, as we've seen over the weekend, it has not changed their diplomatic positions, which essentially remain unchanged from the beginning of the war.
The president will be heading to China soon. At what moment could China potentially play a bigger role to making sure the Iranians actually show up to the table and have a negotiation with the United States?
No country has significant influence over Iranian decision-making. The Iranians, however, do use a number of countries as doorways to diplomatic exits when they wish to do so. And China, Russia, Pakistan could be those doorways when necessary. But we should be clear, China does not have significant influence over the Supreme Council for National Security in Iran, or they would have stopped this war some time ago. We should recall that China was a facilitator for the Saudi-Iranian peace accord of March 2023, and that obviously didn't mean anything.
Where do you think talks stand right now? Because the president yesterday, he announced this operation to guide ships through the Strait of Hormuz, also said that there have been positive discussions with the Iranians.
Well, talks are underway indirectly through the Pakistanis, which indicates that the diplomatic process does exist. And that's a good thing. And it shows that a process exists vice a move towards hostilities. So as long as that trend continues, we're moving in the right directions. At the same time, the president has a good history of showing that when he feels his time has been wasted, he will move to military action. And we do have 2 aircraft carrier task forces in the region, and those military personnel are prepared to initiate operations to clear the Strait of Hormuz, which of course would mean operations against theater ballistic missiles and drones in mainland Iran, were that to order be given.
Norm, always good to hear from you, sir. Enjoy your perspective. Norman Roule there of CSIS on the situation in the Middle East. Here's the situation on Wall Street right now in financial markets. We'll start with stocks. We'll turn to commodities and then get to fixed income. Equities are down by 0.5% on the S&P 500. Some real underperformance on the Russell in small caps at the moment. Turning to crude, Brent and WTI elevated by some 5%. Brent at about 114, WTI at about 107. There was a lift in crude about 20 minutes ago. It's continued. And with that move in crude, this move in the bond market, yields higher across the curve. Two's up by 5 basis points at about 3.93. Plenty of speculation and rumour as to what is happening right now in that region.
Yeah, there's lots of speculation about what is going on. Clearly, Jonathan, though, it is not what we were hoping for maybe yesterday afternoon when the president came out and said the United States is going to be guiding ships through the Strait of Hormuz. There's positive talks between his representatives and the Iranians. Right now, it does seem to think that things maybe took a turn south.
We'll come back to those headlines in just a moment. Coming up on the programme, Laura Galante of WestExec advisors as the Pentagon goes all in on AI, plus your high-risk dropping by. She's got your morning movers. GameStop making a $56 billion bid for eBay. eBay up in the pre-market by 10%. Coming off the back of all-time highs on the S&P 500 and the Nasdaq 100, 5 consecutive weeks of gains on both of those. Equity futures right now on the S&P negative by 1/3%. On the Nasdaq also down by 0.3%. On the Russell down by 0.8. Let's turn to the commodity market. Crude, Brent and WTI 113, call it 114. Crude up by 5% on Brent. On WTI up by 45 at 107. And with that move in crude, you're seeing yields drift higher as well. Two's up by 5, the 2-year at 3.93. That's the setup this Monday morning. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with shares of eBay. They are soaring 10.5% in the pre-market as GameStop makes a pretty audacious move to try and buy the company for $56 billion. I say audacious because eBay is about 4 times the size of GameStop, but it is clearly a move for GameStop to try and transform itself as its retail business continues to shrink. Speaking of shrinking or going away altogether, the collapse of Spirit Airlines over the weekend is it was helping to lift shares of Frontier, though they are now unchanged in the pre-market since Frontier, a fellow low-cost carrier, could have a real opening here to scoop up routes, plus those budget travelers left behind, but it still faces mounting challenges, whether it's ongoing losses or those higher fuel costs. And we end on shares of Coinbase rising 2.5% in the pre-market as the company says it has struck a deal when it comes to stablecoin rewards, which could clear the path for the Clarity Act to move forward. Remember, this is a major piece of crypto legislation, and those rewards have been a key sticking point, facing major pushback from banks who are worried about competition for deposits. John?
Hey, Yahira, thank you. More from Yahira in the next hour or so. On our radar this morning, President Donald Trump said the U.S. military will have to guide ships through the Strait of Hormuz, describing it as, quote, a humanitarian gesture. Iran vowing to attack any American forces that enter the waterway. Elsewhere, China directing companies to ignore U.S. sanctions on private refiners linked to the Iranian oil trade. The unprecedented move coming ahead of a long-awaited meeting between President Trump and the Chinese leader Xi Jinping later this month. And finally, the Treasury Secretary Scott Bessent saying the U.S. blockade of Iranian ports will push the country's leaders to buckle.
Their oil infrastructure is starting to creak. They are rapidly filling up storage, and as that happens, they're going to have to start shutting in wells, which we think could be in the next week. I can tell you that we are suffocating the regime. This is a real economic blockade.
Bessent saying the U.S. is also monitoring Tehran's financial networks and any attempts to move money into the country.
So what's interesting here is the Treasury Secretary, this says this is going to happen next week. And this is what the United States wants to see with this blockade. They want to see basically the regime absolutely crumble because their economy is hitting the end of what it can handle. But here's the thing, Jonathan. April 21st, 2 weeks ago, the Treasury Secretary said that it was going to happen in a matter of days. Now it's next week. The problem this administration might have is that it is just going to take longer than they expected, and that might mean that it might take longer than expected for the Iranians to be willing to feel that economic pain, to be willing to then show up at the negotiating table.
Pretty fast start to the morning already this Monday morning. You would have noticed that around 6 a.m. Eastern time, crude started to pop. Yields did too. Equities started to roll over. There was some speculation, some rumours, accordingly coming from Iranian state TV, that maybe some U.S. ships had been struck through the Strait of Hormuz or around that area. This is from Axios, an official denial from a U.S. official, a senior U.S. official denying that a U.S. ship was hit by Iranian missiles. That headline crossing just moments ago from a senior U.S. official to Axios denying a U.S. ship has been hit by Iranian missiles.
And that's why you're seeing the markets absolutely whipsaw this morning, because we thought there was going to be serious escalation off this Fars headline. I think what's important to remember is that we have seen Iranian semi-official media come out with headlines similar to this when actually it was it wasn't true. It was false. There was no ship that was hit. What we see now is that Axios is saying that they're denying that this happened. I think one thing is clear for certain this morning. There's a little bit of confusion of actually what is happening in the Strait of Hormuz. As the president says, they will guide these ships through. This is not a naval escort. This is electronic guiding. At the same time, the IRGC is coming out and saying they are going to have even more control at the center of the Strait of Hormuz. So it's challenging, not only if you're there running a ship, but also if you're in the financial markets.
Given how many conflicting headlines we've seen, over the last 2 months or so, don't trust, attempt to verify seems to be the approach right now. Equities recovering a little bit. We're down by only 0.1% on the S&P 500. Crude off the highs, up by only 4% now. 112 on Brent. Yields a little bit higher still. That move stays at the front end of the yield curve, by the way, up by 5 basis points on twos. You can call that 393.
I think because the market is also realizing that nothing has changed. Even though the president yesterday afternoon around 4:30 in the afternoon said there's going to be this guiding of escorts, I think a lot of people viewed that as potentially naval escorts, like we saw the United States have in the 1980s when it comes to the Strait of Hormuz. But that is not the case. So how much longer are some of these ships going to be just absolutely locked in the Strait of Hormuz as we go into the 10th week of this conflict?
We'll look to stay on top of that story. That from Axios just moments ago, according to a U.S. official denying a U.S. ship was hit by Iranian missiles. Any more on that, we'll bring it to you. Let's talk about Anthropic's dispute with the Pentagon, showing no signs of easing. The Defense Department reaching deals with other AI giants, including OpenAI, Amazon and Nvidia. Laura Galante, former director at the Office of the Director of National Intelligence, writing, "This is a real signal that the US government is serious about putting AI into the hands of the people operating our most sensitive missions." Laura joins us now for more. Laura, welcome to the program. Can you set the stage for us? Just how is the Defense Department integrating some of these tools?
Thanks, John. So back on Friday, there was this deal that hit 7 of the major AI companies and then also the cloud providers. So you see Microsoft and Amazon, the sort of companies that have long been behind the cloud computing and other parts of compute for the U.S. government. But what this is a signal about how you bring AI to the warfighter into intelligence operations. This has been going on for a while, but this deal is the first outward signal where we see the Pentagon and the national security agencies saying this is core to our ability to counter threats and defend the nation.
We heard from the Palantir executive who said that actually the conflict in Iran right now, when we look back, will be the first conflict that really AI was used writ large. Can you walk us through how exactly in this conflict AI is being used?
So AI, in a lot of ways, is a shorthand for the modernization of intelligence missions and military operations. So when you can use some of the advances we've seen that the AI companies have, that the frontier models have, what you're doing is using a lot of the capabilities that already existed, say, getting the best intelligence from our satellites, from other collection means, and then being able to equip the person who has to operate, make decisions, and then use weaponry with data that can sense the patterns and understand where the best place to either launch an operation is or the best sort of fuel to be able to use that to pinpoint locations and do targeting. So this is about enhancing capabilities that already exist. And that's where you see the Pentagon really figuring out how do we deploy this in the theater where they are today, whether you agree or not with what's going on in Iran. This is what the future of warfare will look like.
When it comes to what we're using right now, a lot of this is based on Anthropic. At the same time, the DoD is saying that's a supply chain risk. Who do you see the DoD working closer with because of this spat they're having right now with Anthropic?
So the signal we have here is that the major AI companies accept Anthropic, right? Google's model and then the model that OpenAI has are the two that the Pentagon's talking about. But from a capability, from a warfighter standpoint, you want all the models. You want to be able to have the tools at your hands to figure out what you do next. And I think this is limiting to not be able to have Claude, to not be able to have Anthropic. The other piece here is that was the first LLM. It was the first major model that the different agencies looked at. So now you have this space where operators have to figure out what else is at my fingertips. I need to be able to look at these models, and they want to have as many different tools to play with as possible.
Other parts of the U.S. government are actually using Anthropic, and we have seen Anthropic executives have meetings at the White House. Do you think at some point there's going to be an end for this spat between the DoD and Anthropic?
I do, and here's why. The real mission, the real call of duty at the moment is to be able to implement AI, modernize our different intelligence agencies and the Department of Defense in a way that can counter what China is doing with their AI advancements within their military and intelligence services. So the game here is China versus the U.S. in how you bring AI into these national security domains. And that's going to override political concerns, I hope, over time here, and to not use the main advancements that the U.S. has implemented within our defense stack would be a real loss for America.
Where is China right now stacking up when it comes to the United States and its AI capabilities in warfare?
So China has the fourth major model, right? And what China's been able to drive towards, and President Xi drives this home, and you see it in the way that they message to their military and to the rest of their state-owned enterprises, is they need to implement AI across the different parts of their economy and military to be effective in the domains that they want to fight in. So they're using AI as a forcing function to be able to modernize and take the money that they're putting into their military and really think about what the next 10 years will look like for Chinese dominance, not just regionally, but globally. So it's a real driving force, and it's one where they have an ecosystem of different companies that are trying to do this well. This isn't just sort of a closed system. They're really emphasizing this across the Chinese industrial base, in a sense, and the contracting companies that help work for the government and the military.
Laura, thanks for making time for us. Laura Galante there of WestExec Advisors. The Anthropic issue is a strange one. It's both a supply chain risk, but also being used in the Defense Department right now.
It's being used right now, and not just at the Defense Department. Other agencies want their hands on it, and actually the Treasury Secretary met with a bunch of bank CEOs to talk about it and they're giving use cases to some of these departments to use Mythos because it is so powerful. This is why you see Susie Wiles having to sit down with the Anthropic CEO. It's this very awkward moment, and potentially why at some point this DOD spat is going to get wrapped up. It has no choice.
No choice. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump suggesting Iran's latest proposal to end the war may not be enough. Axios reporting the plan would set a 1-month deadline to reopen the Strait of Hormuz and end the fighting in Iran and in Lebanon. After that, another month of discussions could begin on Iran's nuclear program. Berkshire Hathaway's cash pile soaring to its highest ever as operating earnings jumped in Greg Abel's first quarter as CEO. Abel also resuming buybacks, giving shareholders a payout for the first time in more than a year. A United Airlines flight striking a light post on the New Jersey Turnpike before landing safely at Newark Liberty International. The FAA and NTSB are investigating the incident. None of the 221 passengers and 10 crew on board were injured. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, durability in the labour market.
We got initial claims the lowest they've been since the 1960s. We got government employment the lowest it's been since the Second World War. And so the bottom line is that it's really strong data.
Up next, we'll catch up with Aditya Bhave of Bank of America from New York City. You're watching Bloomberg TV. Bit of a messy session already this hour. This hour alone, check out the chart of S&P 500 futures. Steep drop-off around 6 a.m. Eastern Time when we saw some reports coming from Iranian media that claimed 2 missiles had hit a U.S. warship. After that ship had ignored warnings. This came from Axios, following up about 30 minutes later. According to a senior U.S. official denying a U.S. ship was hit by Iranian missiles. Equity futures recovering somewhat following that headline. We're down about 0.1%.
A confusing 45 minutes to start your Monday morning, especially given the fact that yesterday there was hope, given the president said that there was going to be escorts guided through, at least electronically, through the Strait of Hormuz. Not naval escorts, but electronic escorts. Now you have Fars saying that there were 2 missiles hit a U.S. warship. A U.S. official telling Axios that's not true. Maybe what this goes to show, though, is that it is still not safe in the Strait of Hormuz for ships to be passing when you see headlines like this back and forth.
Could just run you through the price action just a little bit more. Brent crude still higher by a little more than 3%, just short of 112 now on Brent. We were around 114 off the back of the initial speculation. WTI at around 105. With that move, yield still elevated at the front end of the curve, up by 4 basis points. Twos at 3.92. Let's talk about the labour market. A big week ahead with payrolls on Friday. Under surveillance this morning. Durability in the labour market.
We got initial claims, the lowest they've been since the 1960s. We got government employment, the lowest it's been since the Second World War. We've got all these positive movements in terms of fiscal responsibility and economic growth moving forward. And so then, but we do have this temporary disruption with energy markets. And so the bottom line is that it's really strong data.
The payrolls report due out on Friday. Economists expected to see 65,000 jobs added. Ahead of that report, a busy week of Fed speak. Bloomberg's Enda Curran joins us now from Washington for more. And what are we looking for a little bit later this week?
Well, on the jobs front, John, we're expecting strong data, like you say. Economists expecting plus 60,000 odd jobs created in a month. But not just that. Wages are expected to have accelerated. The participation rate is expected to have increased and unemployment holding steady. Now, if those numbers come through and you combine those with the private high-frequency readings around JOLTS and the unemployment claims and the likes, it will certainly just cement the idea that the labour market is not just stabilising but seems to be in a fairly solid spot, and that's despite the whole story going on with the energy and inflation markets. And, of course, on the inflation front, we have a whole bevy of Fed officials who are going to speak this week. So on the one hand, we're going to get a very important update on the jobs front, and on the other hand, we're going to hear from a lot of Fed officials in terms of what they're thinking now about inflation versus employment.
And we've heard from the dissenters already, the dissenters to the language in the statement. What's the epicenter? What is the epicenter of their argument for Chairman Powell?
The gist of what those three officials were saying, these were the regional Fed presidents, Kashkari, Hammack and Logan, who came out on Friday, John, as you know, with their statements. They're basically saying, look, we are now more worried about inflation than the employment market, and they don't want the Fed to be signalling anymore that the next move could be an easing. That's the gist of where they're from. Now, we don't yet know, of course, how many others are broadly moving towards that camp. We have New York Fed President John Williams today. We have Austin Goolsbee this week. We have Governors Waller and Barr and Bowman here from D.C., all speaking this week. And again, it's going to be a very important week to hear what signal are they sending now on where inflation is at, given that we're expecting somewhat of a strong jobs report on Friday. And remember, John, this is setting the table ahead of the new Fed chair, Kevin Warsh, who's due to be confirmed over coming weeks coming in, where he'll be facing a policy-making committee signalling that they might be signaling they're more worried about inflation than jobs. And that certainly hasn't been a message he's been sending in the run-up to getting the job.
Enda, appreciate the update. Thank you, sir. Enda Curran there, down in Washington, D.C. Aditya Bhave of Bank of America calling for 80,000 jobs added in April, and the unemployment rates remain unchanged. Aditya joins us now for more. Aditya, good to see you.
Good morning. Thanks for having me.
Unmoved and undeterred by what's happening in the Middle East?
So the job market seems to be undeterred so far. You look at the signal from ADP. We don't put a ton of weight on ADP, but it is worth noting that the last few weeks of data have been really, really strong. And then you look at jobless claims as well. They've been very, very benign, down meaningfully in the last week. So there isn't really any sign of the labour market cracking right now.
It's hurting confidence. Is it hurting consumption? Do you see any signs of that at all?
So we've had this issue for 5 years now where consumer confidence has basically just disconnected from consumer spending. We did actually have a few months of weak spending before the conflict, so from November through Jan. And initially it looked like Feb was soft as well. Now Feb got revised up, March looks good. And what we're seeing in our internal card data, because we have these data through late April, is that spending, even ex of gas, has held up rather well.
I saw a note from you in the last week on airlines. Early days, but what are you seeing? Are you seeing a break, a change?
That's an interesting one. Airport traffic has slowed down a bit. There's probably a few reasons for that. There may be some concerns around TSA-related disruptions, the news reports of very long lines. It could be related to higher airfares as well, because typically people book 6 weeks in advance of travel. So to the extent that the Iran war started to affect things, you would have seen it in mid-April. But it also could be the issue with Spirit Airlines. It could be just cancellations.
What about the fact that a lot of people were saying that the bigger than expected tax credits has basically helped people get along when it comes to higher energy prices, like a Band-Aid? That can't last forever, though.
It can't last forever. So our estimate is that tax refunds are up about $45 to $50 billion. This is just based from the Treasury's daily data relative to last year. And we're ballparking the impact of higher gas prices at a little over $20 billion as of the latest data. So it's offsetting about half of the increase in tax refunds, but I'm sure that tax refunds have been one of the contributors to higher spending growth in March and April.
When you look at average gasoline prices today, we're at $4.45, almost $4.50 a gallon. We're getting close to $5 a gallon, which for Americans psychologically is a big impact. Is there a line in the sand where this really starts to hit American consumers?
Right. So what we've heard from some of our equity analysts is that up to $4, when you move from 3 to 4, people feel uncomfortable, but they don't really change their spending habits. Once you get above $4 a gallon, that's where you really start to see changes in consumer behavior. So I think the question is, as folks move away from gas-related spending, so maybe they're flying less, maybe they're driving less, will they replace that with other forms of discretionary spending? Will they eat out more? Or will they just spend less in aggregate? Because if you look at labor income growth, that hasn't really slowed down. We mentioned the tax refunds earlier. So the money for now is just about still there to spend.
You've got the Fed done for the year, right? No cuts.
We have a couple cuts. It's premised on the idea that the Fed chair typically gets what they want. And
so you think Walsh gets what he wants?
Just about, right? So I think that view is being challenged in real time by the recent data flow. I'll be entirely honest about that.
Yep.
Couple things. One is the data. The PCE inflation data have really picked up, not just headline, but also core 3.2%. We could easily head towards 3.3% in April. So it's getting quite uncomfortable. You're overshooting your inflation target, even ex of tariffs, by at least 50 basis points, while the unemployment rate is only about 10 basis points above where they think the natural rate is. So that's the challenge. How far can you push this argument of the chair always gets what they want? But the other thing is, listen to the doves. Don't listen to the hawks. Listen to Mary Daly, who a couple weeks before the Fed meeting really sounded like she doesn't want to cut this year. Waller, I think he probably still wants to cut, but he's saying later and less. And I think Waller's vote is absolutely crucial. Without that, it's very, very difficult for Kevin Walsh to get 7 votes to cut rates.
But you have Neil Kashkari saying potentially you have to hike. Is that just to anchor inflation expectations?
I think that's definitely part of it. There's a view amongst the hawks that you want to keep your options open, and that's a very reasonable argument to make. As even Powell said, he's a dove, but going back to the idea that you're overshooting on inflation more than you're missing on the unemployment rate.
He went one step further, Neil Kashkari. He said we need a tightening of financial conditions somewhat, his words. This could tighten financial conditions somewhat today, pushing back against a high inflation scenario that could require an even stronger monetary policy response in the future. That's the argument from the Minneapolis Fed president.
And you think that if a new Fed chair comes in and gets what he wants, wasn't it this new Fed chair coming in that said inflation is a choice? What kind of choice does he want to make?
You get to choose your index for inflation, apparently, Aditya.
So Kashkari's argument goes back to something that we've been highlighting, which is the K-shaped nature of consumer spending. What is driving the consumer right now? Labor income hasn't fallen off a cliff, but it's somewhat soft. It's the strength of the equity market that is really anchoring higher income spending. So that could be related to the argument that he's making, that if you tighten financial conditions, maybe you can slow down higher income spending, which you need to slow down inflation, perhaps.
Interesting point. Aditya's got to see you. Thank you, sir. Aditya Bhave there of Bank of America. Equity futures on the S&P recovering. We're down by about 1/10% on the S&P 500. Crude still somewhat elevated. Brent and WTI. Brent at around 112, up on a session by 3.6%. In the next hour of Bloomberg Surveillance, we'll catch up with Ross Mayfield of Baird, Henrietta Treyz of Veda Partners, Susan Bell of Rystad Energy, and the former New York Fed President Bill Dudley. The second hour of Bloomberg Surveillance just around the corner.
Consumers are only going to be able to pay higher prices for so long.
Whether they feel poorly or not, they continue to spend.
I don't think the Fed's going to move to hiking if inflation sort of ends up in a good position.
It's hard to argue against the idea of lowering the bar to hike.
Nobody's thinking a recession is imminent.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures negative by 1/10%, off session lows on the S&P 500. In the commodity market, Brent, WTI elevated but off session highs. 112 on Brent, 105 on WTI. In the bond market, yields higher at the front end of the curve, up by 4 on 2s. Your 2-year 392 up by 4 on 10s. 440 and just short of the highs of the year. On a 10-year maturity on 30s, just short of 5%, 498. Already a pretty interesting morning so far. If you missed the last 60 minutes of price action, initially stocks down off the back of a report from an Iranian news agency suggesting that 2 missiles had hit a US warship after ignoring warnings. This came from Axios, that a senior US official has denied all of that, denying a US ship was hit by Iranian missiles.
So honestly, Jonathan, another Monday morning where we're starting with a lot of confusion of what is actually going on with this conflict. If we can go into the realm of speculation for a moment, if a U.S. warship was hit, you would have seen immediate fire back and return from the United States. Second, we do have the President of the United States yesterday say that they are going to guide ships through. Now, this is not naval escorts, according to a report from the Wall Street Journal, but this does seem like electric guidance. But what happened yesterday when the market opened? Immediately we saw crude take a fall. Could this just be the Iranians wanting to play the market just as much as many speculate this administration does?
So we got that initial headline from Axios, and now we have it on the record from U.S. Central Command. They claimed that Iranian state media claimed that Iran's Islamic Revolutionary Guard Corps hit a U.S. warship with 2 missiles. The truth, no U.S. Navy ships have been struck. U.S. forces are supporting Project Freedom and enforcing the naval blockade on Iranian ports.
What isn't clear, though, if a missile was actually at least launched, came close to a U.S. warship. That we do not know. I think one conclusion you can make right now is that there is still a lot of confusion amongst vessels on if it is safe or not to go through the Strait of Hormuz. We also heard from Iranian state media today that they are going to have a new, more secure zone, the IRGC, when it comes to the Strait of Hormuz. They want to maintain that control just as much as the U.S. wants to maintain the blockade.
Precisely that point. All the volatility is super confusing. What's the one constant? The blockade continues. The energy isn't flowing in the same way. What's the one constant? The president seems comfortable to continue to the blockade with no real change over the weekend.
Right, this impasse is continuing. The Treasury Secretary said yesterday that the Iranian oil industry is basically on the brink, and we can see shut-ins as soon as next week. The issue is, we heard this before from this administration. 2 weeks ago, the Treasury Secretary said we were just days from these shut-ins. We do see an economic, really, consequences hitting across the economy in Iran. They're starting to put some oil on rail to go to China. So they obviously are trying to find ways to store some of this energy and get it out. But it might be more than just happening next week. It might take weeks, and also it could take months.
Equity futures this morning negative by just 0.1% on the S&P. Coming up this hour, we'll catch up with Ross Mayfield of Baird as equities pull back from fresh all-time highs. Henrietta Treyz of Veda Partners as Spirit Airlines collapses, and the former New York Fed President Bill Dudley on Kevin Walsh's case for lowering rates. We begin this hour with stocks turning lower on renewed tensions in the Middle East. Ross Mayfield of Baird writing, the US blockade is working, but will take time to force Iran's hand. The question is, does the market hold up in the face of this risk? Ross joins us now for more. Ross, good morning, sir. Answer your own question. Do you think it does hold up?
I think the risk is that the administration takes the market at all-time highs as a vote of confidence in a longer standoff, this blockade being the main way that goes about. And that if it goes for, another month, there will be economic ramifications in the second half of the year that are hard to see right now. So I think it can hold up if we're a week away. I think if we're talking weeks or months, it's a much bigger question for an economy that's already, fairly narrow and being propped up in a lot of ways by AI spend and not the strength of the consumer, which has obviously had some trouble in the face of higher
Ross, that's the debate right now. Economic ramifications. So we see the consequences in Asia. They're on the horizon, if not the reality right now on the ground in Europe. For the US has got a lot going for it right now. $700 billion of capex coming from just a handful of companies, more than that if you include others. The rate cuts already in the pipeline from the end of last year. The tax refunds hitting bank accounts already at the moment coming into this quarter. Can it stand up to the risk elsewhere?
It can. I mean, I think it's the main reason, along with corporate earnings, which have been robust, that the market is back at all-time highs despite what is still clearly a very live war in the Middle East, and despite oil that has now been over $100 a barrel, both Brent and WTI, for a lot of the last 2 months. So there is a lot working for the economy, but there are two things that the economy can't stand up in the face of, which is higher for longer oil or really higher for longer rates. If we continue down this path, we run the risk of a little bit of both if we put the Fed in such a bind because of higher oil prices.
Well, let's go with the rate story. So we're up 4 basis points at the front end of the curve on twos today at around 392. Not far off the highs of the year at the front end. On 10s, we're basically there. Likewise on 30s. Ross, what does a 5% 30-year, 440 10-year, let's call it 4% 2-year, do to equities?
We've seen over this bull market, particularly the 10-year, when it pushes past 450 and starts to move towards 5, that's really the red zone for risk on equities. The 30, I think the market cares a little bit less about, but that 450 on the 10-year is a really key level. So obviously market watchers and investors will be all eyes on that for the next couple of weeks here. On the front end of the curve, I think it's representative of a Fed that is going to have its hand forced. And I don't think we're talking hikes yet, but certainly it would be surprising to see a cut, in particular following the dissents from a handful of governors last week.
When you say it has its hands forced, that basically just means you think the Fed is on hold for the rest of the year?
Yes, I think so. I think it would be really hard, even if Warsh makes a convincing AI productivity case, to build consensus to get a rate cut, unless we're talking about maybe a rate cut in December if we can get past Iran, in a timely order. But yeah, I think a base case should be a hold for the remainder of the year.
Ross, if you're watching the market, what would it take for the Fed, do you think, to have to actually hike?
It's core inflation, right? So I think the Fed is rightfully saying all the right things about looking through an energy shock, but we've also seen some pressure in core services inflation. We know the labor market is really tight in terms of, we're not adding jobs. The labor force is probably even shrinking. So if you started to see wage pressure, if you started to see housing and rents bottom and turn back up, then the Fed is forced to reconsider where we're at. The problem is the labor market doesn't look strong enough to stomach many hikes. So we'll keep an eye on core services inflation, but I think the Fed is, again, kind of caught between a rock and a hard place here, which maybe makes their job easier in some ways.
So what kind of Federal Reserve do you think that Kevin Warsh is inheriting when he steps into the big seat in June?
Obviously a very split Fed. I mean, we haven't seen so many dissents in a couple of decades at least. I think it's going to be really hard to build consensus towards a view that AI productivity merits rate cuts. Now, I think you might get a little bit more consensus on winding down the balance sheet a little bit, maybe on some of the banking regulation issues that the Fed has a hand in. But I think it's going to be really hard to build consensus, even if the economic argument is sound, because of all of the other noise from Iran, from the labor market, and from what AI might do to jobs.
We've had plenty of noise already this morning. Ross, appreciate your time. Thank you, sir. Ross Mayfield of Baird. Between 6 and 7, tons of noise shaking up this market. On Kevin Warsh, the case for cutting interest rates. Bill Dudley, the former New York Fed president, doesn't think there is a case to cut interest rates this year under Kevin Warsh. We'll catch up with Bill a little bit later. I do think his piece begs another question, though. If there isn't a case for interest rate reductions later this year, then why is there still an easing bias under Chairman Powell at the current Fed?
Right. There has been an easing. That's a great question. There has been easing bias. And guess what? Jay Powell is sticking around. And I know this probably is annoying the administration. The Treasury Secretary said yesterday he thinks it's only going to be for a short period of time. But you have to remember, this is an individual who also has a dovish slant. So maybe at the end of the day could actually help Kevin Warsh if he was trying to, get the cats together to finally agree on an interest rate cut.
You've seen the pushback, the dissents to the language in the statement. We had some details around those dissents going into the weekend from Beth Hannock of Cleveland. I see this clear easing bias is no longer appropriate. From the Dallas Fed President Lori Logan, it could plausibly be appropriate the FOMC's next rate change to be either an increase or a cut. Echoed by Neil Kashkari of Minneapolis, the FOMC should offer a policy outlook that signals that the next rate change could be either a cut or a hike. Do they find some company in the next month? Governor Waller later this week. That's the speech to watch.
Everyone is looking at Governor Waller because remember, he is the one that actually could potentially be the individual that convinces the committee if they were going to take that next step and actually have another interest rate reduction this year. The interesting thing, Jonathan, though, is a lot of this depends on when this conflict wraps up. And right now what we're seeing is that the impasse just continues.
And the volatility in markets continues as well. Equities dropped away around 6 Eastern time off the back of this report from an Iranian news agency claiming that 2 missiles had hit a US warship after ignoring warnings. And then we've had the official denial from the US just moments ago, shaking up this equity market in more ways than one in the last 60 minutes or so. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. As we've been saying, the US is denying claims from Iranian state media that an American warship was hit by missiles. Iran had claimed 2 missiles struck a US vessel. US CENTCOM posting on X that naval forces are supporting Project Freedom and enforcing the naval blockade on Iranian ports. U.S. Attorney for the District of Columbia, Jeanine Pirro, says she may reopen a criminal investigation into Fed Chair Jerome Powell, depending on the results of an Inspector General's probe. Pirro dropped an inquiry into Powell last month after a federal judge blocked her grand jury subpoenas. Shares of Norwegian cruise liner trading lower in the pre-market after reporting first quarter earnings that missed estimates. The cruise liner also cutting its full-year EPS outlook, signaling it's on track to be the cruise operator most impacted by the Iran war. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, a failed bailout attempt.
Spirit Airlines ceased operations. So if you have a flight scheduled with Spirit Airlines, don't show up at the airport. There will be no one here to assist you.
Up next, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. So here's the state of things. A lot calmer now than they were about 60 minutes ago. We're down by 0.15% on the S&P 500. On the Nasdaq, we're totally unchanged. On the Russell, down by a third. The Russell small caps at 1 point an hour ago, down by close to 1% with this move in crude. Crude off the highs, still up by 3%. Brent 111 was close to 114. WTI around 105. With that move in crude, yields pushing higher across the curve. Two's out by 4 basis points, 392. The Iranian state media reporting about an hour 15 minutes ago that a US ship was hit by Iranian missiles after ignoring warnings. We've had the official denial from the US side that ever took place about 15 minutes ago.
CENTCOM is saying that did not happen. What I find interesting is that you do have also the Joint Maritime Information Center coming out talking about an enhanced security zone being established by the United States to support transits. At the same time, Iranian media is saying that they are announcing a new control zone in the Strait of Hormuz. So which is it? When it comes to this potential control zone or enhanced security area, who actually has control right now? We understand the U.S. blockade is working. But does the United States really have control and are able to guide electronically ships out of the Strait of Hormuz? The next few days are going to be critical to see if that's working.
We'll stay on top of that story for you. Equity futures so far this morning negative by just 0.1% and well off session lows. Under surveillance this morning, a failed bailout attempt.
Spirit Airlines ceased operations. So if you have a flight scheduled with Spirit Airlines, don't show up at the airport. There will be no one here to assist you. Now, you've heard that other airlines have talked about requesting a $2.5 billion bailout. I would say that at this point, I don't think it's necessary. If they want to come to the U.S. government, we would be a lender of last resort.
So here's the latest this morning. Spirit abruptly shutting down following a surge in fuel prices and a failed government bailout. Bloomberg's Tyler Kendall has the latest from Washington. Morning, Tyler.
Hey, John, good morning. Well, a person familiar with the matter tells us that it became clear to the White House last Thursday that a deal couldn't get done. The U.S. government had been considering a $500 million bailout in exchange for warrants to purchase up to a 90% stake in the company once it emerged from bankruptcy. But the U.S. Transportation Secretary Sean Duffy there went on to say that at the end of the day, it was a creditor issue, as the Wall Street Journal reports that a group of key bondholders felt that they would be better off with Spirit liquidating rather than agreeing to the government's terms. President Trump repeatedly said that he was interested in trying to help save the company in a bid to save jobs. In fact, we had reported last month that the administration was even considering invoking the Defense Production Act in an emergency effort to keep the company afloat. This tracks with perhaps the more hands-on industrial policy from this White House, considering the U.S. Commerce Secretary Howard Lutnick was the one leading these negotiations, of course, a leading voice in that U.S. government deal that we saw last year with Intel. But, John, as you well know, this company had been struggling for years, but its issues were really compounded by the fact that we are seeing this surge in fuel prices due to the closure in the Strait of Hormuz. And the Transportation Secretary alluded to it there. We heard from the Association of Value Airlines, which represents other low-cost carriers. They're asking this government for $2.5 billion in assistance, but so far, the administration has said that's not going to happen.
Tyler Kendall with the latest in Washington. Tyler, thank you. Let's go through some simple questions. Could this airline stand alone? No. Would a combination with JetBlue have made things different? We'll never know. But the market offered a potential solution to all of this about a year ago, and it was blocked on the grounds that it would reduce competition. What have we ended up with a year later? Less competition. Less competition and also less jobs. There are a number of jobs now that are going to be lost because Spirit is obviously bankrupt and they are no longer flying. A number of planes also that are just left now and routes that are not being flown at all, and individuals flocking and potentially having to pay double the fare or higher prices to get a flight. The other issue, of course, is if you take the flip side, say this merger did go through and Spirit was really, really bad, which we know they are. Could that mean that the bigger JetBlue Spirit also be in a position much worse today than they would have been had they not brought on Spirit? Senator Warren is attempting to deflect blame. Of course, she was part of the big push to block this combination under President Biden, saying that Donald Trump's war with Iran caused the sky-high fuel prices that finally did Spirit Airlines in. I'm not sure it was just the fuel prices that did Spirit Airlines in. Remember, Spirit Airlines already filed for bankruptcy twice. They filed for bankruptcy twice, this company. So I'm not sure it's really the jet fuel, especially given the jet fuel issue is really at this moment hitting Europe more so than it's hitting the United States. Joining us now to discuss is Henrietta Treyz of Veda Partners. Henrietta, welcome to the programme. Do we need to rethink in Washington about the kind of deals that make sense and the ones that don't?
Actually, I had a really amazing weekend up in Canada with members of parliament and trade teams and the business councils up there. And one of the things that they're most focused on is understanding what Mark Carney is going to do on the Sovereign Wealth Fund and what Canada is going to invest in. You know, they're talking about defense, they're talking about industrial and manufacturing. And it begs the question, what is the United States going to invest in? We obviously have seen the president try to invest in Intel, and he's taken a very hands-on approach, as Tyler just walked through. But they made the judgment that Spirit Airlines wasn't going to be one of those pieces that goes into what the United States decides to permanently invest in. And we've seen how those play out, from an auto bailout to the farm bailouts, bank bailouts. You know, we can get into the weeds. And I think the other dynamic here is that obviously Spirit's had issues for years. That's not up for debate. But when you put 84% increases in a very tight margin industry on their main cost of fuel, that's the end of the story. So calling attention to that for whatever the duration of this war is going to be, and having sort of the first American casualty of the war and the higher jet fuel prices is probably a bad look for the administration. So that combo makes a lot of sense to me.
Henrietta, do you think now, given, I mean, me and Jonathan were just talking about the fact that there was potentially an off-ramp for Spirit when it comes to JetBlue and the Biden administration blocked it. Do you think potentially now members of Congress would get on board if we were to see more consolidation in this space?
I think it's a lot to ask of members of Congress to get on board to do anything. These guys are barely functioning right now. As you saw, the House went on recess instead of staying in session. They are just coasting on their own jet fumes to get to the midterm. So I don't think a bailout or even an organized, coordinated approach, unless the war really does collapse whole industries, kind of like what the airlines are alluding to and what the whispers all are, I don't see Congress wanting to weigh in here. It paints a bad picture for the administration, and that's not what Republicans want to provide to the president going into this midterm cycle. So I think they probably just stay away.
But Henry, are you saying that members of Congress actually think Spirit collapsed because of the war in Iran? Because they've been struggling for years and in August filed for Chapter 11.
Right. No, I think it's a combination of both. The problems have persisted for years. They didn't think it was worth it to bail it out. But I mean, 84% increases in jet fuel is going to do it for you. So whether it's the entire story is not correct, but it is obviously the straw that broke the camel's back. And there's no restraint from Congress on the president to wind down the war. And I think that needs to be really, internalized, that there is not material pressure on the president to end the war immediately. A lot of Republicans would say, don't waste this crisis. We're here now. Let's see what happens. It's worth it. And if they wrap their hands around the idea that, avoiding an IRGC with a nuclear weapon is worth the price of Spirit Airlines, so be it. I think that is what a lot of members would say right now.
Well, if this is the case and it's higher fuel costs, what do you think the Department of Transportation should be doing right now with other budget airlines?
I mean, hopefully preemptively getting them to avoid going into this kind of dire last-minute situation where you can point to, a Thursday like last week and say that was the make or break point. If you want to get out in front of it, you really need to create something. Throw it in the Farm Bill, throw it in forthcoming CR. Give assurances behind the scenes. Let Treasury kind of work something out so that they can get some sort of swap line in through there. Those are all options that we've seen either through the pandemic or through the Great Recession that are available to these agencies. They just have to want to do it. And I imagine that there are teams at Treasury working on that right now.
Henrietta, when did we become so scared of markets? When did this start? How many decades ago?
Like just free markets, you mean?
Precisely.
I think that the federal government decides to step in a lot. I mean, I am not really that old, but I've already seen bailouts of so many sectors, like the auto bailout. I mean, at one point there was a request to bail out golf clubs during the Great Recession. There are bank bailouts, there are farmers bailouts. We're on our fourth farmers bailout in the Trump's term for the 2 terms that he's had so far, number 4, and we're asking for a 5th. I mean, we intervene a lot.
Henrietta, appreciate it. Henrietta Treyz there, of Veda Partners, down in Washington, D.C. I see a lot of politicians rage against capitalism all the time. I'd like them to identify what do they think is capitalistic about the current environment.
You mean taking equity stakes?
You should want to process a creative destruction. I know it's brutal, it's painful, particularly for the wrong end of it. But also the market, the free market, did provide a solution in the last year, and the government blocked it. And I know everyone wants to move on from that because we've had an energy shock. I haven't seen Ryanair go under in Europe off the back of this energy shock. I think we've got to talk about, yes, this was a business model that was struggling to stand up on its own before this energy shock, but the market offered a solution and the government blocked it.
Right, or EasyJet or Wizz Air, a number of these European airlines, which actually Europe is being hit hardest when it comes to jet fuel, and the Commission actually is going to put out tactics some of these airlines can use in the next few weeks and months, given the fact that the situation in Europe is so much worse. But to your point, there was a solution to this. Spirit has been in trouble for years, and JetBlue was willing to take on that problem, and the Biden administration blocked it. Now, what we do not know, though, is that would that have been beneficial, or potentially would it leave JetBlue today in a worse condition because they would have taken on this massive problem?
That debate will continue, no doubt, in Washington, D.C. For the here and now, equities recovering well off session lows. We're down by just 0.1% on the S&P 500. Energy elevated, still in triple digits on both WTI and Brent crude. The last 90 minutes in financial markets. This is why people are so exhausted. You see headlines from Iranian media suggesting a U.S. ship has been struck in the Middle East, and then you're getting official denial from the US. And still, some of the move actually holds this morning, still, in the bond market too.
Well, the move holds because there's a lot of confusion, and there's really still this impasse, and there's no agreement about actually guiding ships through the Strait of Hormuz. We haven't seen the president's directive actually take shape right now. And that's why you have this confusion. That's why some people just want to stay on the sidelines.
Up next on the programme, we'll talk about energy. We'll catch up with Susan Bell of Rystad Energy, with oil rising on reports of heightened tensions in the Middle East. Back-to-back gains on the S&P 500 coming into Monday at all-time highs. 5-week winning streak, the longest winning streak on a weekly basis going back to October 2024. Equities this morning negative by 0.16% on the S&P 500. On the Nasdaq 100, just about unchanged. In the commodity market, what a ride already this morning. Brent at about 111, call it 112. Still elevated this morning, high by some 3%. Rumour, speculation, a report from state media in Iran suggesting US ships had been struck, then denial from the U.S. officials.
Yeah, CENTCOM saying that's not true. What we don't know is whether or not potentially there was a missile that was fired or a drone and it came close. We need more information about what is actually going on in the Strait of Hormuz, and that is why potentially you see oil prices still elevated. That anxiety still lives on because it is unclear if any ships are going to be getting out, given what the president said yesterday in his Truth Social post that they would be, quote, guiding ships through. You know, immediately everyone thought this meant maybe naval escorts, but not. It's electric guiding. And how many ships can you actually get through with that, especially when the IRG says they actually have a new control zone and they are controlling it?
Yeah, language matters. Guiding is different to escorting. That language really matters, the difference between guiding and escorting. Let's turn to the bond market. This move in crude, push it into fixed income. Yields up across the curve. 2s at 392, 10s near the highs of the year, 441, and 30s just short of 5%. Yields up at the long end by some 3 basis points.
How much can these higher yields continue without biting into the equity market? It's going to be another very busy week, Jonathan, as we try to digest all that is going on with the conflict. But also, as you mentioned earlier, it's a huge week for economic data when you have jobs data on Friday.
And Treasury refunding, I think, on Wednesday. Looking forward to that in a few days' time, too. Bramo is going to be back tomorrow morning. She'll give you a preview of what to expect. Let's get you some single name action, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with the big corporate story of the morning. We are seeing shares of eBay rising 8% in the pre-market as eBay makes a bold bet trying to buy the e-commerce company for $56 billion. eBay is about 4 times the size of GameStop, so that's why it's a bold move, but it's clearly a move by the company to try and fast track its transformation as its core retail business of selling video games continues to shrink. Turning to an earnings story, Norwegian Cruise Line Holdings shares are down 6.7% in the pre-market after it cut its full-year outlook. The company now guiding for its first annual profit drop since the pandemic. It has been the biggest hit among its competitors, of course, due to higher fuel costs tied to the war, but also Norwegian saying that they're seeing consumers pull back on travel, especially when it comes to travel to Europe. And we end on Coinbase. Those shares are rising 2.5% in the pre-market after the company said it has reached a deal when it comes to stablecoin rewards, which could clear a path for the Clarity Act to move forward. Remember, this is a major piece of crypto legislation, and those rewards have been a key sticking point with banks pushing back due to worries about competition for deposits. John.
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, Spirit Airlines shutting down following failed bailout talks with the White House. Rivals, including United and American, launching price-capped rescue fares to help stranded passengers. Elsewhere, GameStop making a $56 billion unsolicited bid for eBay, a 20% premium to Friday's close. GameStop CEO saying he plans to turn the online marketplace into an Amazon rival. And finally, President Donald Trump announcing a plan to help guide ships through the Strait of Hormuz, describing it as a, quote, humanitarian gesture. Tehran warning it will attack any U.S. forces that enter the waterway.
So this was an important Truth Social post from the President of the United States, and I think the market took it in kind. And immediately you saw at 6 p.m. last night, equities were rising, futures, and then when it comes to crude, you saw a precipitous drop. The issue, of course, then was the Wall Street Journal clarifying that this was not, to your point, this was between guide and escort. This was not a naval guide, naval escort. This was basically electronic guide. What is interesting is that you do have from the Joint Maritime Association of the United States basically saying that they are going to have this essential zone through the Strait of Hormuz potentially to guide those ships. But the IRGC is coming out and saying they have a new control zone through the Strait of Hormuz. And that is why there's anxiety in the market still. Not just what Fars was saying, that they hit a U.S. warship, CENTCOM saying they did it. There's anxiety in the market because there's no clarity on exactly what is going on in the Strait of Hormuz and who is actually
Well, let's
controlling.
build on that story. Let's go through that story just briefly. So Iranian state media said they hit a U.S. ship. The U.S. is saying on the record, officials are saying no ship has been hit. What we're trying to work out is whether any missiles were actually fired, whether there was a skirmish earlier on this morning in that region.
Right. And I look at the CENTCOM tweet and I understand that this is probably definitely true from CENTCOM, because if a U.S. warship was hit, do you know what the fire back would be on the Iranians? it would be so obvious that open source would be able to pick this up. But to your point, is there something that happened in the middle? Was there any sort of skirmish? Are the Iranians out there with these speedboats, with drones? Are they trying to attack U.S. forces as the president is trying to guide some ships out in a humanitarian effort? The next few days are going to be critical to understand if any of this is effective.
We are all looking for additional clarity. We're high by 3% on Brent, 111, just short of 112. WTI at 105 and up by 3% on that contract as well. The Treasury Secretary Scott Bessent saying the US pressure campaign on Iran could push its leaders to surrender.
Their oil infrastructure is starting to creak. They are rapidly filling up storage, and as that happens, they're going to have to start shutting in wells, which we think could be in the next week. I can tell you that we are suffocating the regime. This is a real economic blockade.
Joining us now to discuss is Susan Bell of Rystad Energy. Susan, welcome to the programme. Scott Bessent, the Treasury Secretary, his words, in the next week, Iran may have to start shutting oil wells. Do you agree?
Yes, absolutely. That aligns with our assessment that they are running out of containment.
Do you think that kind of blockade and the fact that they would be breaching storage capacity, which might compromise their wells, would bring them to the table?
I think it does, actually. And as a matter of fact, you know, they have been issuing proposals at a fairly rapid pace. I mean, the last one, I think, came out on Saturday, perhaps Sunday, where they returned a 14-point proposal back to the U.S. The two key sticking points remain at uranium enrichment and control of the Strait of Hormuz.
Susan, when it comes to shut-ins, this is potentially interesting because 2 weeks ago, the Treasury Secretary said it was a matter of days. Now it's saying it's next week. What we see the Iranians do is bringing out very, very old vessels to try to just store crude on the water. We see them putting crude on rail to get to China. Don't they have other means potentially make this process a lot harder and longer?
It's possible. I mean, there is also news of them using some old abandoned tanks to store oil. They could even use above ground sumps if it gets really dire. And when I say above ground sumps, what I really mean is, you know, ditches in the ground where you just store the oil on in the ground. It's possible, but it's certainly not ideal either from an environmental perspective or from the quality control of the oil. Our assessment is that they are running out of containment.
What happens when there is shut-ins? What kind of damage is going to be done to their industry?
Well, I mean, if the shut-ins are over a very short period of time, there won't be that much damage to the reservoirs, and the production could recover fairly quickly. The longer that the shut-in is sustained, though, that's when you start to see issues with the geological formations, and you can have water coating, you can have pressure loss. There's just a number of issues that could develop, subsurface that prevents full recovery of production once production starts flowing. Of course, from the economic perspective, Iran is really facing many economic challenges with a number of their people now moving into poverty, food supplies, medical supplies. The nation itself has benefited from being under global sanctions for the past 4 decades or so, that they have become somewhat self-sufficient, but they still need that oil revenue to fund their economic activities. And I think that certainly does bring them to the table a lot quicker.
So, Susan, that's Iran. What about the rest of the oil industry? We do see WTI this morning holding on to 105 when it comes to per barrel. Do you see the paper market finally catching up to what the physical market has been pricing in?
That certainly has been the trend over the past couple of weeks. I mean, when it was, late March, early April, the paper markets were well lagging the physical markets. We still do see some fairly strong premiums for the physical crude oil, particularly dated Brent, which is supply that is available somewhere between 10 to 30 days from 10 to 20 days from the the date that you've nominated your slot. And WTI landed in the Northeast, like in Europe. Sorry, we do see some very strong premiums there still. But certainly, what has happened is the market structure, meaning the future months, has strengthened relative to the prompt months. So we are seeing that curve flattening out, which definitely indicates that the paper market is starting to price in sustained supply disruptions.
Can we talk about the outlook, the much longer term? What happens after this war is finished? The more interesting thing that the Treasury Secretary said over the weekend was this, that the oil price may well be lower than it was before the start of the war, that crude may actually be below where it was before it was when the war started. Susan, what do you think about that? The future, post-Iran and this war, what the future is like for the supply of energy?
Well, I think, the one key event that happened this past week that could actually make that a reality is the UAE removing itself from the OPEC cartel. The UAE has designs to grow their production to 5 million barrels a day. Before the Middle East crisis, they were producing at about 3.4 million barrels a day. And certainly, if they add that supply to the market once everything opens up and starts flowing through the Strait of Hormuz, directionally it means the market is longer crude oil, and that will push prices down. Our view is that, once the Strait opens, there is going to be a period of months, upwards of 6 months, where we will continue to see prices seeing some support because we have to see strategic stocks being refilled and commercial stocks also being refilled back to more sustainable levels.
Susan, it's good to see you. That's the counterpoint. Susan Bhave of Rystad Energy, thank you very much. The bear case for crude from Mr. Besson.
And potentially the UAE is helping that bear case. Javier Blas put out a tweet earlier from the top energy official from the UAE, Dr. Sultan, and he said basically this exit wasn't directed at anyone, although there has been quite the spat for months, and this was a long time coming in terms of how the UAE has felt about the Saudis really running the show at OPEC. But it says that gives us, the UAE, greater ability to accelerate investment, expand, and create value, a.k.a. put more barrels on the market.
It's an important call from the Treasury Secretary over the weekend. Let's give an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Indian Prime Minister Narendra Modi is set for a landmark political win. His party is on track for its first ever election win in the key opposition-ruled state of West Bengal. The results show a major turnaround from the general election in 2024. Secretary of State Marco Rubio is heading to Italy later this week to meet with Pope Leo. The meeting will mark the first high-ranking encounter between the pontiff and a senior administration official since President Donald Trump criticized the Pope. 3 people are dead from a suspected outbreak of the rare hantavirus on a cruise ship in the Atlantic Ocean. The World Health Organization says an investigation is underway. The Dutch operator of the cruise ship saying it is now sitting off the west coast of Africa. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, an uncertain outlook.
There's so much uncertainty about the outlook in the Middle East right now. I don't feel comfortable signaling that a rate cut is in the cards. We might, in worse scenarios, we might have to go the other direction.
Up next, we'll catch up with the former New York Fed President, Bill Dudley, from New York City. This is Bloomberg Surveillance. The state of play so far this Monday morning looks like this. Equity futures on the S&P 500 negative by 0.2% on the S&P, coming off all-time highs in Friday's session, pulling back just a touch on the Nasdaq, down by 0.1. Underperformance on a small cap, so I'll get to why in just a moment, down by 0.6. For crude, elevated. WTI and Brent crude 112 and up by 3.5%. And with that move, this move in bonds, which is probably upending the move in the equity market on the small cap side of things. Yields up by 4 to 5 basis points on 2s, 392. 10s at 441, just a line in the sand, if you will. Closing high of the year so far, only a week or so ago, 442.98, just short of those levels.
And all of this morning, a lot of whipsaw on the financial markets, given what is going on in the conflict in Iran. FARS came out, a report, rumors that they had hit a U.S. warship. CENTCOM said that is not accurate. But the issue is the anxiety still lingers because right now there's an impasse and we're not seeing ships get through the Strait of Hormuz. And it does seem for this moment, even though the president is talking about guiding ships out, at this moment it does seem like the IRGC is still in control of the Strait of Hormuz.
So what does this mean for monetary policy? Things get tricky. Under surveillance this morning, a fragile outlook.
At this moment, the labor market seems like it's okay. But if this conflict is prolonged or if it gets much worse from here, then I think that could be a real downward shift to the growth trajectory of the U.S. economy. There's so much uncertainty about the outlook in the Middle East right now. I don't feel comfortable signaling that a rate cut is in the cards. We might, in worse scenarios, we might have to go the other direction.
So here's the latest this morning. 3 Fed officials signaling caution about the central bank's path forward. The former New York Fed President Bill Dudley seeing no good reason for Kevin Walsh to lower interest rates, writing his latest rationale that inflationary pressures are subsiding is no more convincing than its predecessors. Bill joins us now for more. Bill, welcome to the programme, sir. What is the strongest argument against not cutting interest rates right now?
Well, I think two things. Number one, the risks of inflation have increased, obviously, because of the continued rise in energy prices. And number two, that the labor market seems to be pretty stable. We're not seeing a lot of job growth, but we're seeing enough job growth to keep the unemployment rate from rising. So I think that the balance of risk is actually shifting more to the inflation side, away from the labor market side. Second thing is that there's no real evidence that monetary policy is actually restrictive right now. We've had supposedly a restrictive monetary policy for quite some time, yet the economy is operating at full employment. And inflation is well above the Fed's 2% objective. So the evidence that monetary policy is actually holding back the economy, I think, is pretty weak in the current environment.
Bill, what do you make of the AI argument? It wasn't something that was articulated in the hearing, but it's something we've heard from Kevin Walsh before in the lead up to his confirmation, that ultimately it will lead to lower prices. It will give them room to reduce interest rates. What's the pushback to that?
I think the pushback to that is twofold. Number one, AI in the short term is actually increasing investment demand. So that's actually pushing upward pressure on interest rates. Number two, there's a lot of uncertainty about how fast the AI productivity benefits will materialize. And it's not really clear whether that will, what will dominate, the downward effect on inflation or the upward effect on the demand for capital and that effect of that on interest rates. There was a poll of economists that basically found that over 80% of the economists said, no, I would not recommend cutting rates now prospectively on the basis of an AI productivity boom. The other weakness of the argument is that Kevin Walsh has cited the Greenspan experience in the late 1990s as a reason to cut. Well, the reality is Greenspan did not cut in the 1990s. He just didn't raise interest rates. And interest rates at the time were well above where they are today.
Bill, do you think that's just a sequencing problem? What's your ultimate view, your personal view on the matter? Is that a sequencing issue, that it's expensive up front, it pushes up costs, there's a clamour to buy all kinds of things, and then later on costs fall?
Well, I think AI, if we do get a productivity surge, it's going to be good for the outlook for inflation. I think it's less clear what that means for interest rates, because if AI results in obsoletes a lot of the capital stock and you need to sort of build new capital to take full benefits of AI, you could actually see continued upward pressure on real interest rates.
No good reason to cut rates. That was the title of your piece right now, Bill. You echo that in this conversation. It does beg the question, why is the current Fed chair and the committee maintaining an easing bias?
I think they start with the presumption that, number one, monetary policy is restrictive, which I don't really agree with. And number two, that they're concerned about the downside risks to the labor market. I think those downside risks to the labor market were probably pretty relevant, a few months ago, but the labor market seems to have stabilized. Look at the level of initial unemployment claims and total unemployment claims. They're really basically as low as they've been in many, many years. So there really is very little evidence that the labor market is falling apart at this point.
Bill, what do you make of Chair Jay Powell staying on for longer than many have anticipated, given he will be a former Fed chair at the next meeting?
Well, it's clearly unusual, but not without precedent. And, for the people that are criticizing, Jay Powell for staying on, I think that's not really fair. I mean, he didn't start this whole situation. The Fed has been under merciless attack from the president, and the Fed's independence is under question. And I think Powell thinks that by staying on the Fed, that's going to actually bolster the Fed's the perception of the Fed's independence. So I think it makes sense for him to stay on if he's willing to do so.
I believe over the weekend, the Treasury Secretary called it an overreaching shadow Fed chair. Do you believe that this will be confusing for financial markets to have what some might think two co-chairs?
Well, I think Powell has made it very clear that he's going to keep a very low profile. So I don't think you're going to see Powell going out and giving a lot of speeches about the economic outlook and the implications for monetary policy. But obviously, around the committee, when they have the actual FOMC meeting, it's going to be pretty relevant what Chair Powell says about the economic outlook. People are certainly going to continue to listen to him.
Bill, obviously, the incoming Fed chair is going to want to do it his own way. What kind of changes would you advocate for in communication, whatever it might be, fewer speeches, the dot plot? What would you change?
I think there are a lot of things that they could change and improve. I mean, I think that, number one, you need a framework for quantitative easing and quantitative tightening. They don't have one right now. When do you do it? How do you do it? How do you exit from it? How do you evaluate the cost and benefits of it? Number two, I think they really do need to improve their communications. And I think what I would recommend, and this is something that Ben Bernanke recommended, is to actually publish a staff forecast with scenarios, alternate scenarios. Scenario analysis right now is so relevant in an environment where we don't know how high oil prices are going to go or how long they're going to stay high. So having different scenarios that basically say how you respond if things turn out differently than you expect is very helpful information to guide markets. So I think, the ECB does this. I had a conversation with Christine Lagarde a couple of weeks ago about this. They have three scenarios: baseline, adverse, and severe. And she basically said, every day that the situation in Iran stays the way it is today, we're taking one more step away from the baseline scenario towards the adverse one. So having alternative scenarios, I think, would help people think better about monetary policy.
But is it harder when you have a dual mandate?
I don't think so. I mean, I think the dual mandate, I think people overestimate the tension in the dual mandate. At the end of the day, I mean, I think the Fed's view is we need to keep inflation at 2% because that's actually going to help us more easily achieve our employment objectives. So the two are not quite as much tension in the long run. They're in tension in the short run at times, but in the long run, you really need to keep inflation at 2% if you're actually going to achieve your objective in terms of employment.
Bill, appreciate your time and the piece. Great column. Enjoyed the read. Thank you, sir. The former New York Fed President, Bill Dudley, available on Bloomberg.com and under the Bloomberg Opinion vertical on the Bloomberg terminal, if you can find that piece from Bill. Great piece. In his opinion, certainly entitled to his own opinion on the matter. He does not think that Kevin Warsh should be cutting interest rates here.
And maybe Kevin Warsh does have some cover. Remember, the Treasury Secretary saying that maybe right now is not the right time. Maybe they need to wait a few months before they start to reduce interest rates. But obviously, this is something the President of the United States would want to see. One thing that Bill Dudley does mention in this piece is that the persistent rise in energy prices shouldn't be dismissed as noise. The big question is, how long is this actually going to last?
In fairness to Kevin Warsh, he didn't make a big effort to communicate an argument to cut interest rates in the hearing.
No, and I think, and you've brought this up a number of times, I think one of the most important things he said was a little bit at shots thrown at team transitory, but something he might have to abide by. Inflation is a choice.
Up next, we'll catch up with Jitania Kandhari of Morgan Stanley, Tom Kennedy of JPMorgan Asset Management, Yelena Shulyatyeva of the Conference Board, and Kelly Kowalski of MassMutual. The third hour of Bloomberg Surveillance just around the corner.
I would not be outright short risk.
Stay invested. Don't try to time this market.
It's a little bit of a high convexity trade still.
The market isn't necessarily going in and rewarding everyone.
We still think the broadening story is happening.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. You're opening about 90 minutes away. Equities into it look like this. Equity futures negative by 0.1% on the S&P, just about unchanged on the Nasdaq. In the oil market, an update on crude. Brent crude up by around 3% to 111. It was up by 5 a little bit earlier on the session on some conflicting headlines about developments in the Middle East.
But still holding on to some of those gains. And those conflicting headlines comes from Fars in Iran saying that they actually missiles hit a U.S. warship. CENTCOM said that is not true. One thing that we do hear, though, from the United Arab Emirates is that an ADNOC vessel was transiting in Hormuz, and that was hit by 2 Iranian drones. So what this does show is that the IRGC is still going after Western or Western-affiliated and their partners' vessels, and maybe that's why you're seeing this risk premium still in the oil market.
That's keeping crude elevated. Bond yields too, higher by 4 basis points on the session. Your 2-year at the moment at 3.92. Your 10-year north of 4.40. For the bond market, the next step The next stage is the data. It was all about earnings last week. This week is all about the economic data, and a big one is on Friday. Payrolls Friday just around the corner. The median in our survey, the median estimate is 65k. The high is 140, the low is -15, so the range is still wide, wide, wide.
The range is so wide, it's really, anyone's bet, like a casino, what happens on Friday when it comes to the payrolls report. But what is notable is that the U.S. economy has been resilient in the face of all these headwinds. Even Jay Powell said that at the press conference, the outgoing Fed chair, whether or not it was tariffs, whether or not it's the Iran conflict, you do see the economy and the consumer at the moment resilient. At some point, does it start to break, especially when you see gasoline prices ticking higher, closer to $5.
We'll speak to the conference board a little bit later about confidence. When you say resilient, confidence is terrible. It is just on the floor right now, if you believe in the likes of you, Mitch. Rock bottom. Consumption's still okay based on the spending data we've seen. Retail sales has been okay. We spoke to Bank of America earlier on this morning looking at their card data. That's holding up too.
When I say resilience, I'm talking about the data, because when you look at things like University of Michigan, it basically feels like a political poll, and also a place where people, of course, maybe when they say, how do you feel about the economy right now? Maybe they just went out and filled up their tank and they're saying, well, I'm annoyed. Well, of course, they're going to have that knee-jerk reaction, but individuals are still going out and they're still spending.
Futures this morning negative by 1/10% on the S&P, with the opening bout just around the corner. In just a moment, we'll catch up with Jitania Kandhari of Morgan Stanley, with stocks pulling back from all-time highs. Tom Kennedy of JPMorgan on the AI data center boom. Yelena Shulyatyeva of the conference board as rising gas prices weigh on confidence. We begin this hour with stocks lower and crude rising as geopolitical uncertainty puts the record rally on hold. Jitania Kandhari of Morgan Stanley Investment Management writing, markets are acknowledging risk, especially on energy, but the dominant force is still earnings and AI-led capex, with geopolitics acting more as a volatility amplifier than a regime breaker. Jitania joins us now for more. Jitania, good morning. Good to see you. Are these the trends, the forces you want to fight? If you're on the wrong side of this trade right now, how painful are things?
Yeah, it's a great question. I think what's happening on one end, as I said, is the AI-driven capex, which has been a bigger contributor to U.S. GDP growth in the last year than consumption, which has traditionally been the highest contributor to growth. So I think there's merit in this momentum. What I do worry about is how the duration of the Iran conflict can finally come to roost. And at this point, of course, there are offsets. What's really interesting is that as much as U.S. has energy and independence, if you look at countries in North Asia like Taiwan and Korea that have exports to the extent of about $700 billion compared to past $250 billion, and you contrast that with energy imports, which is basically, energy importing countries are in Asia. Energy imports are about $230 billion. So the gap between the export revenues and their energy imports is so high that even a tripling in prices doesn't really move the trade deficit. So what's going on is all of these offsets in the U.S., of course, with the lower gas prices, but even in other pockets of the world, like North Asia, which are traditional energy importers, but have some interesting offsets. So we're really being discerning in terms of how we are investing, trying to buy uncorrelated sources of alpha wherever we can find them. And at this point, clearly, tracking how this duration of this energy disruption holds up.
I think for a lot of people, they've tried to make this quite simple. They've found some price-insensitive spenders right now, big buyers of all this technology. The hyperscalers in this country spending north of $700 billion, or at least intending to this year, and they're going to where the money's been spent. They're going to the chip players, and they've been piling into that trade, and that trade has moved from 40 to 50% off the lows from the end of March. Do you think there is a better way to express bullishness beyond just that very narrow trade at the moment?
Absolutely. So I think, even within AI, there are three layers. One is infrastructure, which is what you talked about, the chips and servers and networking. The second is models, which I think will be commoditized by the end of this. And the third is applications, right? In applications, you have the agentic applications, which is software, and the embodied applications, which is physical AI. Now, physical AI has its own ecosystem because robotics, humanoids are coming. talk about defense, and modern warfare is all about human without being in the loop. What does that mean? We've looked at LiDAR companies, which are needed in the physical AI world. So we're exploring the ecosystem beyond the traditional AI plays into the next AI second derivatives. And of course, software also looks, it's like first software was eating the world, now AI is eating software. But I think you need to be discerning.
Do you think this is a world where hardware and software can perform well? Because at the moment it feels like one versus the other.
I think AI is a full cycle capital stack, right? As I said, it ranges right from the infrastructure, the picks and shovels traditionally, to applications. So I think it's not wise to be just hardware, software, but to kind of diversify across the capital stack. And even look at, like I said, the next era of embodied AI, physical AI, and what that means.
Is there enough in that story right now to ignore what's going on in terms of the conflict in Iran?
I think we can't ignore it. If you see the monthly numbers, there is demand destruction going on as well. About 3 million barrels of demand destruction has happened. There's data center rationing in Asia. Restaurants are getting closed in some pockets of Asia. So it's important to keep in mind what that means, because at some point, if this is going to impact growth, I think the markets are really poised for perfection. And even at the IMF meetings 10 days ago, the policymakers were extremely nervous. There is a big gap, JPMorgan called it cognitive dissonance, big gap between what they think is the extent of damage with 80 plus energy facilities having been destroyed, and a third of them severely destroyed. So it's going to take time to ramp that up. So I am concerned about the spillover if this blockade lasts long.
You have an interesting perspective, because what the policymakers are thinking versus what the C-suite is thinking is a really large gap. And you were also at the Berkshire Hathaway over the weekend, the meetings. What did you learn there? Where are they deploying capital? Are they concerned about this conflict?
Yeah, so Berkshire the meetings was not about what they've invested in, it's about what they've not invested in. They're sitting in with a lot of cash. The bar for capital allocation by Warren, Greg, is very high. They did mention there are several great narratives in the market, but very, very few mispricing. Patience is their strategy, and they think that it's discipline versus participation in these markets. So and even on AI, it was pretty pragmatic in the sense, yes, there's energy efficiency that'll come with it. Too early to replace human judgment. Very, very different from,
How instructive do you find that
say.
weekend? Because if I take two charts, their cash pile up and to the right, and plot it against the equity market up and to the right, does it make sense to be in cash for this long, to have a cash pile that big?
I guess as Berkshire Hathaway you can, but as investors, we have given money to not hold cash. So you really have to be invested.
Well, what's the difference? Why would you want to give money to someone else just to hold T-bills? You wouldn't, right?
I wouldn't. I'm an investor, and I think that, as I said, there's an AI stack in the world. It's broad-based. There's an industrial stack in the world: defense, automation, electrification. There are great domestic economies, even in Europe, which is some countries are gas intensive, like Germany, UK. But some have great renewables, like France and Spain. There's the emerging universe with terms of trade beneficiaries, because all of this is going to need commodities. Brazil has 5 million barrels of crude production. It exports 2.5. There's a lot of opportunity outside, both within and outside the US. And I guess that's what we're trying to do.
Jitania, it's good to see you. As always, thank you. Jitania Kandhari there of Morgan Stanley Investment Management. Equity futures stable, negative about 0.1% on the S&P 500, with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. The U.S. is denying claims from Iranian state media that an American warship was hit by missiles. Iran had claimed 2 missiles struck a U.S. vessel. U.S. CENTCOM posting on X that naval forces are supporting Project Freedom and enforcing the naval blockade on Iranian ports. A United Airlines flight striking a light post on the New Jersey Turnpike before landing safely at New York Liberty International. The FAA and NTSB are investigating the incident. None of the 221 passengers and 10 crew on board were injured. Former New York City Mayor Rudy Giuliani is in a critical but stable condition at a Florida hospital. In a social media post, President Trump calling the 81-year-old a true warrior and the best mayor in the history of New York. That is your Bloomberg Brief. John.
Vonnie, thank you. Thank you for the update. Up next, we'll get you some morning calls. Plus, we'll touch base with Tom Kennedy of JPMorgan on the AI data center boom and the commercial real estate play in this country. From New York City this morning, good morning.
There is a lot working for the economy, but there are two things that the economy can't stand up in the face of, which is higher for longer oil or really higher for longer rates. If we continue down this path, we run the risk of a little bit of both if we put the Fed in such a bind because of higher oil prices.
That was Ross Mayfield of Baird joining the programme a little bit earlier. Equity futures right now in the S&P 500 negative by 0.1% on the Nasdaq, firmer by 0.1%. Muted price action now, but 2 hours ago, anything but pretty volatile price action. There were some headlines crossing, according to state media in Iran, that a US ship was struck by missiles. Denial about an hour later from US officials, but in between, equities down, crude higher. The move in crude still sticks just about. Brent crude was up by about 5%, now up by 2.5, close to 111 on Brent. WTI at 103, and with that move, push it through bonds. Fixed income yields higher by 4 basis points on a 2-year, 391, and that move has stuck this morning across the curve.
So CENTCOM is saying no U.S. Navy ships have been struck, and obviously you would see, I think, pretty immediately the U.S. fire back. But it is notable that the UAE is talking about an ADNOC vessel that was trying to move through the Strait of Hormuz was actually targeted by the IRGC, which is why you see the risk premium continue in the oil market. A lot of anxiety and just really uncertainty in what's going on in the Strait of Hormuz.
There is some real risk over there, but we're insulated by earnings. You've heard that so many times on this programme. Mike Wilson, Morgan Stanley, publishing just moments ago. Resiliency this earnings season is broader than appreciated, with a median stock EPS growth rate of 16% and a beat rate of 6%, the strongest in some 4 years. That's why stocks are still at all-time highs. That's the price action. Let's get you some morning calls. First up, HSBC downgrading AMD to hold, citing limited upside potential, expecting server upside to be capped throughout this year. Your second call from Oppenheimer, upgrading Airbnb to outperform, saying the company is well positioned to absorb travel dislocations from oil supply shocks while benefiting from World Cup demand. And finally, Baird downgrading Alexandria Real Estate to neutral, saying operating backdrop remains challenging. That name is down by 0.7%. Let's stick with real estate. As AI spending skyrockets, the race to secure power and space for data centers is creating opportunities in the commercial landscape. Tom Kennedy of JPMorgan writing, power is the new diversifier. We've moved from a US economy fueled by the checkout line to one fueled by the grid. Tom joins us now for more. Tom, good morning.
Good morning.
Good to see you. You alluded to it. I want you to build this out. The commercial real estate needs of the last 20 years.
Yep.
And what you think the needs will be for the next 20 years.
Yeah, I think it's a great place to draw the line in the sand is when China joins the WTO in 2001 and the era of globalization is upon us. We built out a logistics network where we could get goods, John, to your house here in New York City in 1 hour, and it took 20 years to get there. That has been the driver of the commercial real estate boom and industrial sector. But now with rising geopolitics, with COVID, we now need to onshore and reshore certain assets and certain businesses that they all need high power. We talk a lot about a data center needs a lot of power, but the applications for AI and these onshore businesses also need a lot of power.
So we've got the wrong mix right now. How's the build-out going at the moment?
Very slowly. For the last 20 years, over that era of globalization, America built about 5 billion square feet of logistics and warehouse, to get those goods to you really fast. We only built about 300 million square feet of manufacturing space. But over the last 4 years, annual increases in demand for manufacturing space up 50%. Really haven't seen that in 20 plus years. So the supply and demand imbalance is quite big.
If it's going slow, what can be the accelerant in this?
Well, it's going slow to build a manufacturing operating center just takes a long time. So there's a time constraint, Annmarie, is one part of it. The other is we have to be able to build these high-powered manufacturing buildings in only certain places. America's grid is not set up as one big, beautiful grid. It's set up as 3 very distinct grids, and power is not easily transmitted across them.
It could be.
It could be. It needs some advancement and technological advancement.
Also, cutting of red tape. Are you seeing more of that from this administration?
Well, the grids are a little bit different. The grids are the energy grids that don't talk to each other. There's one in the east, one in the west, and then Texas. And to be able to have them talk is a networking problem that isn't necessarily red tape, some of that. But within certain states, you are seeing accelerants to, say, onshoring and reshoring into those areas. New York is one of them. Texas is another one. So there is some element of this red tape, but across state lines and the grid, that's a harder one to fix.
Just curious, where does office space fit into all of this?
So far, in the last 12 months, office is the best performing commercial real estate sector. It usually shocks people. How could that be?
It does sound shocking, so how could it be?
Well, a couple of things are happening. The return to office thing is real. JPMorgan is emblematic of that. We're in the office 5 days a week.
So is Bloomberg.
So is Bloomberg. There we go. But there are other companies following trend there, and we're just not building new office buildings. It takes 4 or 5 years to build an office building. And right now in the pipeline is a small amount of new supply coming in the next 5 years. The majority of it is already pre-leased. So supply picture is restrained, but we're coming back to the office. Maybe not every day of the week, but on Wednesdays, for the most part, we're coming back.
This is what people worry about, though. You get this demand boom, and then people start building.
That's right.
Then you get the supply bust further down the line. And it's the worry. And this applies to a whole range of things beyond commercial real estate. This applies to, say, chips, manufacturing, all kind of things. Is it too soon to worry?
It's incredibly too soon.
Are we talking like decades? Because the way people talk about this is that the timeline is so long. Don't even worry about it.
A really simple way that I think about this question of will there be a supply boom in commercial real estate? Well, to build a building right now is about 25% more expensive than the value of the building that you're looking at, on average, across commercial real estate. So you can look at that a couple of ways. Why would anyone build until this gap closes? Or I can buy this existing property and put at least 25% of upgrades in it before it becomes someone want to build next to me. So we should not be worried about supply boom right now in commercial real estate. The only meaningful investment in new supply coming is in this high-powered industrial space.
The next question is how this fits into our portfolio. So let's start with exposure, and then we can get to the diversification stuff that I want to spend some time on. How do you take exposure to these kind of things? What are you advocating for at the moment?
So in the alternative space or in private markets, commercial real estate is the biggest sector. So as you look at a portfolio, a lot of people have exposure to this. It's a relatively mature private investment. But as you start to broaden out now, we are in a new era of diversification, coming back to where we started. The era of globalization caused bonds to be a great diversifier. In an academic sense, why? Well, inflation was very low. So if growth came down, the Fed could just cut rates. But if growth came up, they didn't necessarily hike rates. Now we're fighting inflation from the top side. So new diversifier. Nominally resetting diversifiers, commercial real estate, infrastructure, to some degree hedge funds. I think that's the place to be.
Can I take you into a different asset class? Just
Please.
Bonds, just pure vanilla fixed income. If the diversifier is different and things have changed, and I knew why I was buying that for the last 20 years because it gave me certain benefits, introduced certain characteristics into my portfolio in very simple terms, and it's not doing that anymore. Are people going to buy less fixed income?
To some degree, by definition, they should. If I was buying bonds in the globalization era for yield and diversification, I think now you're mostly buying it for the yield, and yet yields are higher. So I think there's offsetting characteristics there. I think if someone in their portfolio is now saying, I need to own bonds, it better be for the income. That's the predominant benefit it's offering to you in your portfolio.
Where does that lead state finances? And how are you thinking about those things?
I think it leads to a place where there's probably higher term premium than we've been used to. In most of our professional careers here, term premium, this concept of can I get a yield lower than what I expect the yield of the bond to give me over the life, like relative to a risk-free rate, as negative, we shouldn't expect that anymore. And academic models are showing you term premium is coming up. If this environment persists for a long time, I think it should continue to rise. And it does challenge the ability to finance more risky types of bonds.
That's what I wanted to get into just a little bit more. The future portfolio, just how different things are going to be in the next 10, 15 years.
I think the two dominant things that will be different. One is this concept of term premium, which should separate winners and losers in the bond market, which we really haven't seen materially in the last maybe 10 years, ex-COVID. And the other is this movement from public markets to private markets. It's much more efficient for a bank to allow someone else to give a private credit loan. So the notion that this market is just happening haphazard is not true. It's more of a structural regulatory shift. Those are the two dominant shifts.
Do you think it's unfair that let's just say the PR, the way people talk about private markets, has been reduced to just BDCs and redemptions?
Yeah.
Has that bugged you when you go around talking about some of these issues?
A bug is a little bit more aggressive than I would say. I think it's just a misunderstanding of how the environment has shifted. And again, a big bank's ability and willingness to give a small whole loan to a small business, it's just not a good use of their capital. They can do other things with it. So it's created this environment for alternative managers to step in and do that in a more efficient way. Ex-central banker in me. Well, sure. A bank is 8 to 12 times levered. A private credit business is 1 to 2 times levered. It is less risk, assuming there's good backstops and ability for those asset managers.
Tom, thoughtful stuff. Lots to consider. Thanks for being here. Appreciate it. Thank you, sir. Tom Kandhari there of JPMorgan Asset Management. If you are just joining us, equities recovering here, almost unchanged on the S&P 500. More headlines just moments ago.
Right. We have a tweet from Central Command saying that basically the U.S. Navy guided missile destroyers are currently operating in the Arabian Gulf after transiting the Strait of Hormuz in support of Project Freedom. American forces are actively assisting efforts to restore transit for commercial shipping. This is the key. As a first step, 2 U.S.-flagged merchant vessels have successfully transited through the Strait of Hormuz and are safely headed on their journey. We really have not seen that, and that would show that this guided effort when it comes to Project Freedom is working. On the one hand, though, Jonathan, we also got an update from ADNOC talking about this vessel that was targeted by 2 Iranian drones. So potentially there's good news in Project Freedom, but also the IRGC is still going after certain ships.
Things are still fragile. Crude still elevated. Off the highs, though. 103 now on WTI. Brent crude just north of 110, 110.60, and up by 2% on the session. We've talked lots about that move in the bond market. Off session highs for 2-year yields, 10s as well, and 30s. 2s now at, let's say, 391. 10s are just short of 440. Up next, we'll catch up with Yelena Shulyatyeva of the Conference Board as rising gas prices weigh on consumer confidence. Plus, your hires back with your morning movers. eBay surging on interest from GameStop. That stock is up by 7%. The opening bell about 60 minutes away. Equity futures on the S&P negative by, let's call it 0.1%. No drama here. We closed on Friday, all-time highs. On the Nasdaq this morning, adding a little bit of weight to that rally, up by 0.1%. As we count you down to the cash open, 1 hour away. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We have some earnings to get through. We start with Tyson. Those shares are up 1.3% in the pre-market after the company boosted its full-year outlook thanks to strong demand for its protein, especially chicken, that helping to offset weakness in its beef business, an area that's still losing money as tight cattle supplies keep costs elevated there. Turning to another earnings story, Norwegian Cruise Line Holdings shares are falling 6.4% in the pre-market after it cut its full-year guidance, guiding to its first annual profit drop since the pandemic. The company performing the worst among its cruise line peers thanks to higher fuel costs, of course, but Norwegian also saying that they are seeing consumers pull back on travel, especially to Europe. And we end on our big corporate story. eBay shares soaring 7.5% in the pre-market as GameStop offers to buy the company for $56 billion. It's an audacious bet, with eBay about 4 times the size of GameStop, but that company trying to perform a turnaround. John?
Yahara, thank you. Thanks for the update. Appreciate it this morning. Let's turn back to the economy. A busy week of data coming up with loads of Fed speak, and the headline on Friday, the headline data point is Payrolls Friday. Bloomberg's Mike McKee has more for us. Good morning, Mike.
Good morning, John. Well, let me start with what's not going to happen this week. The Senate's out of session, so Kevin Warsh is not going to be confirmed this week. Look for that maybe next week. Also, the Supreme Court is not issuing orders this week, as far as we know, and so no Lisa Cook decision is coming. But beyond that, as you mentioned, a lot going on. Tuesday, ISM Services will be looking at the jobs component, and we'll be looking at the prices paid component on Wednesday. ADP jobs, same story about the labor market. Is the labor market hanging in there? We'll get productivity on Thursday. Everybody be looking for some evidence of AI in it. Probably too early for that. But then, of course, Friday is the big day with the April jobs report, and we'll see if the unemployment rate stays unchanged. The forecast 4.3%. If that's the case, the Fed feels better about not having to cut. The employment mandate test is Friday, as I mentioned, and it's not just 4.3%, but do we still see companies hiring at all? The forecast is for about half of what we got last month, and private payrolls making up more than half of that. Average hourly earnings would tick up to 3.8%. The K-shaped economy is always a concern these days. And as you mentioned, a lot of Fed speak this week. The highlight probably comes at the beginning and the end of the week. John Williams, vice chair of the Open Market Committee, the New York Fed president, is speaking today. Tomorrow we get two governors speaking. And then Friday, Chris Waller, who was one of the first Fed governors to say we should cut rates back when they began their cycle, who is now suggesting that maybe it's not time to. So we'll see if he has any update there. So a lot to watch for this week, and we'll be on top of all of it.
He's the one to watch without a doubt, Waller, on Friday. Mike, just to dissect some of the dissents that we saw and the explanations for them, Neil Kashkari's was somewhat interesting. He's making the argument for a tightening of financial conditions ahead of time, just in case they have to hike interest rates, because the job would otherwise be much bigger, Mike. What did you make of that argument?
Well, it's an interesting argument because, as you heard Bill Dudley say earlier on your show, that he doesn't think that the monetary conditions are very tight right now. So if you wanted to move the markets, you could change your bias to a neutral bias, could go up, could go down, which would signal the loosening cycle is over and probably send yields up some.
Mike McKee with the latest. Mike, looking forward to your coverage. Payrolls on Friday and lots in between. Let's turn to the consumer. Yelena Shulyatyeva of the Conference Board warning rising gas prices are weighing on confidence. She writes the following. Inflation is starting to broaden beyond energy and should widen further through peak driving season, adding more drag on consumption. Yelena joins us now for more. Yelena, good morning.
Good morning.
That's where I wanted to start, the relationship between confidence and consumption. How tight is the relationship right now?
I think it's actually tighter than we usually talk about.
Tell us more.
I think at least directionally you see consumer spending is slowing, and consumer confidence, at least as measured by the Conference Board, is starting to stabilize. So remember, they were so different, right? So consumer confidence was plunging and consumer spending was so strong. I think now we see some convergence going.
Can you explain that convergence, particularly from consumer confidence up? What's happening there?
I think consumers are just, look at the economy, see what is going on. It's not really, falling off a cliff. And they do see the news. They see the unemployment rate is steady. Those who want to work are still working. So, they're happy about it.
This is the difference, I think, in survey construction. When we talk about you, Mitch, so much of that seems to be pinned on what's the price of gas. Gasoline's above $4 a gallon. Is yours much more focused on the labour market? And do people feel better about their prospects in this jobs market?
I don't think they really feel better. There's still a lot of difficulty finding jobs. But I think it seems to be stabilizing at least. So another thing that we ask about is financial conditions, like financial conditions for your family, not economy overall. And financial situation is not as great, and consumers are worried about it. So this is, I think, is one of the reasons we see that consumer spending is slowing.
Well, we have north of $4 a gallon of gasoline. The highest ever was under the Biden administration. It was June of 2022, north of $5 a gallon. Are you seeing similar responses to what we saw that June?
In terms of consumer confidence, I think that we see it in other different measures beyond the headline index. So there's a lot of pessimism in the writing responses. So we're not only measuring the index itself and the subcomponents, but also asking consumers to tell us in their own words what is going on. There's a lot of concern, and there's an increase in the mentions of gasoline, higher inflation, and things like that.
At the same time, so many Americans got bigger tax refunds. Is that helping them in terms of cushioning their pocketbooks?
Maybe just temporarily and partially. I think the bigger result is going to be that it's going to last, and I think it's probably going to last longer than we think. And if oil is at an average of $100 per barrel, as it is right now for Q2, I think that shaves off 0.4 percentage points from GDP growth. This is according to our estimates.
I know it's really hard to speculate, but do you think gasoline goes through $5 a gallon as we approach peak driving season?
Peak driving season. That's exactly.
Are consumers preparing for that mentally?
I think they're worried about it, but until that happens, consumers will probably continue to spend. So there's this tension between what we expect and what is actually happening right now.
Can we finish on AI and the labour market? I'd love your thoughts on this. Note of the weekend came from Torsten Slog of Apollo. A much better outlook for the jobs market. He wrote this: nearly 2 million workers in the Philippines now work in call centres, up every year since 2016 and through the AI boom. He says as AI makes call centre work cheaper and faster, companies are buying more of it, not less. Lower cost per interaction does not mean fewer interactions. It means more customers served, more channels opened, and more markets worth reaching. I thought that was really promising because many people are concerned that AI is going to destroy certain parts of the jobs market. How constructive are you?
Well, I am pretty constructive actually on AI. So that seems to be the engine driving, labor market growth. So companies looking beyond the temporary disruption in the Strait. So I was visiting members in a couple of weeks, and I was talking to CFOs, and they are like, well, we have to look beyond uncertainty. We cannot just stop investing. And that's what they're doing. They're looking beyond that temporary disruption, no matter how big it is, and they're investing and they're
things picking up at entry level as well for the younger workers too. I've seen some charts recently that seem a little bit more promising than certainly what I'd feared.
I really hope so. I really need to see more of that. Still, things are much worse for the younger generation than it is for overall labour force.
Let's hope things change. Yelena, it's good to see you. Thanks for being here. Yelena Shulyatyeva there of the Conference Board on the outlook for the labour market. I thought the note from Torsten was great. One of the most exposed industries for hiring, AI, the call centres, you'd think things would be cratering, that apparently the things that tech is supposed to be hurting right now, it's fueling expansion, at least for that.
Yeah, that's what he says. The technology is supposed to shrink the industry, is fueling its expansion, but those 2 million workers were hired in the Philippines. What does that mean for America, an American's workforce? Does this mean AI, you're able to put those jobs elsewhere and at a cheaper rate outside of the United States? This is going to be a massive political problem, not just for this midterm election, but for 2028.
Let's get you up to speed on the price action. Stocks right now in the S&P 500 negative by 0.1% on the S&P. In the bond market, yields high by some 3 basis points on twos at 3.91, and crude still somewhat elevated. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. Spirit Airlines shutting down after failing to secure a $500 million bailout from the Trump administration. The company posting a statement early Saturday morning saying, quote, all Spirit flights have been cancelled and guests should not go to the airport. A blockbuster opening for The Devil Wears Prada 2. The Walt Disney, movie starring Meryl Streep and Anne Hathaway, making $233 million worldwide. That makes it one of the year's largest opening weekends. In sports, a trio of Game 7s over the weekend in the NBA. The Cleveland Cavaliers eliminating the Toronto Raptors and the top-seeded Detroit Pistons defeating the Orlando Magic. Also, the Philadelphia 76ers coming back from a 3-1 deficit to upset the Boston Celtics. They will take on the New York Knicks with Game 1 tipping off this evening. And that is your Bloomberg brief. John.
Very cool, Vonnie. Thanks for the update. Thank you. Up next on the programme, setting you up for the day ahead. Plus, we'll catch up with Kelly Kowalski of MassMutual with the rally stalling ahead of the opening bell. Equity futures just about unchanged.
The
the market is no longer asymmetric like it was as we were advocating in March and April. You've still got a little bit of upside, but at the same time, we have to work on the assumption there is back to a negative decay for risk assets, i.e. the longer this goes on within the Straits of Hormuz, the more problems we're now going to face. A lot of the buffer that we had in place going into this debacle is now going to get eroded.
The price of the story has changed. That was Alex Altmann of Barclays following a double-digit rally off the lows at the end of March and gains of 40-50% on certain semis. The chip index absolutely ripping since the end of March and the March low. Equities this morning stalling somewhat. Equity futures negative by 0.1% on the S&P after closing at all-time highs in Friday's session. Similar story on the Nasdaq, with positive by about 0.1%, just about unchanged really across the board here. In the bond market, things get a little bit more interesting. At least they were more interesting earlier in the session. Yields were more elevated than this, but still through 390 on twos at around 440 on tens as crude picks up steam. 110 on Brent. WTI still in triple digits. Thursday, Friday, big two-day drop of about 8%, but this morning we pick up again by, let's call it 0.75% on WTI. Things are still tense in the Middle East.
Very fragile, very tense at the moment, especially this morning with a number of headlines whipsawing, Fars saying that Iranians hit a U.S. warship. CENTCOM said no. Here is one positive note, though, coming out of CENTCOM, saying 2 U.S.-flagged merchant vessels has successfully transited through the Strait of Hormuz. That's incredibly positive, given the fact that the president said they were going to guide, not escort, guide vessels out of the strait.
There's a big difference between guide and escort, that's for sure. As we count you down to the cash open, let's talk about the week ahead. Last week was all about the earnings. This week is all about the data. At 10 a.m. Eastern Time, we get durable goods. Tomorrow, PMI data and results from AMD. On Wednesday, Disney reports. Plus, I believe through the week we get ADP and jobless claims. Jobless claims, of course, drop on Thursday. On Friday, it's the payrolls report. Stocks at the moment very close to all-time highs following a series of headlines from Iran that whipsawed equity futures earlier on this morning. Kelly Kowalski of MassMutual writing the following: even with this uncertainty, it's difficult to turn pessimistic in the near term amid stellar earnings momentum. Kelly joins us now for more. Kelly, welcome back to the program. How impressive has that earnings story been?
Well, Jonathan, thanks for having me. Good morning. I think coming into this earnings season, the bar was relatively low, but we've just blown it out. And granted, a lot of that has come from the AI CapEx story. And we've seen second quarter earnings expectations inch up, as well as, year-end 2026. So I think it's not hard to really look at the results we've seen and be that surprised that the markets continue to rally, even amid, long dated crude futures continuing to inch up.
Kelly, we saw throughout the year people itching to rotate away from big tech, itching to rotate into other markets, international markets, whether it be Europe or Asia, some big performance in places like South Korea and Japan. And now it just feels like the central US tech trade is back and it's drawing more and more people in once again. What do you suggest they do about concentrated risk? Is that a feature or a bug?
I think it can be both for investors. So, we look at the equity markets as well as the bond markets where you are seeing growing concentration, and it really means continuing to pick your spots and have a little bit more patience. We've seen a huge flow of CapEx related issuance in our IG credit space, and it's caused us to be just a little bit more patient there. I think it's hard to fade it too much in equity markets because you have such a supply demand mismatch. When you have these hyperscalers with over $1 trillion in backlogs, it's hard to be too negative there with that disconnect between supply and demand.
Kelly, in your report, in your notes, you talk about how earnings are underscoring several encouraging signals. There's still this resilience, especially in the upper echelons of society, to continue spending. And you say, what war? Is this market just basically in a position to shrug off what is going on in the Middle East?
I think for now you have all of these tailwinds, right? You have the CapEx bill, you have the buffer from the fiscal side. The average consumer is getting $3,500 to $3,700 in tax refunds. So that's all good and well for now, but I think as we get into the remainder of the year, this war may start to matter more as you see the commodity inflation feed through, the food inflation feed through, and eventually that leaks into services on top of maybe the services inflation we already have right now. So for now, we're seeing a lot of positive tailwinds, but we are prepared for that to face some challenges as you think about some uncomfortable inflation prints we may see and the upward pressure in bond yields.
Well, what does that mean, this higher potential inflation prints? This administration was talking about a war that could last 4 to 6 weeks. Now we're entering the 10-week. Is there a line in the sand where you have to start to rethink some of the impact?
I think there is, and there's obviously midterm elections coming up, but November is a long way away. But there is only so much that can be controlled when you think about the negotiations and the strategy now. Is, even if this does get concluded in short order, how do things come back online? And given, the impact to fertilizer shipments, how is that going to impact, the crops that were planted? There's still a lot in motion, I think, that has happened that we still have to see the impacts of, regardless of if this, concludes in 2 weeks or in another 4 to 6 weeks.
Kelly, many investors stopped caring about this issue on this side of the Atlantic, in New York, in the United States, and have stopped caring for quite a while now. What do you think that moment looks like when they start to care? If there is that moment, what do you think it will look like?
I think the consumer is, hoping that this gets resolved, and I think the market is pricing for the same. But you're probably going to see a slowdown in the consumer. I mean, I think you've already seen it with, Bank of America reporting that travel slowed down in April. You saw some earnings reports from Domino's Pizza, from Wingstop, that it was mattering for the consumer. But you probably would see it get a little bit more broad-based. I don't think sentiment can get any lower than it is right now if you kind of look at some of the readings. But as you sort of get into the second half of the year, do we expect the consumer to collapse? Probably not, because you've still got that high-end consumer still spending. But they're going to be muddling through a little bit more, and it is going to get, probably more dire for certain people.
Kelly, appreciate the update. Thank you. Kelly Kowalski there of MassMutual on this market, going into the opening bell about 39 minutes away. Eyes on crude. Right now, Brent still rising, but off this morning's highs. The US is denying claims from Iranian state media earlier on this morning that an American warship was hit by missiles. For an update, I want to cross over to Tyler Kendall down in Washington, D.C. Tyler, what is the latest this morning?
Hey, John, well, you mentioned it there. We got this confirmation from CENTCOM that no American Navy ships have been hit after Iranian state media had reported that there were some strikes. CENTCOM also went on to confirm that so far 2 U.S.-flagged merchant vessels have transited through the Strait of Hormuz. This comes on the heels of President Trump announcing what is being called Operation Freedom to help move vessels through that the president says are neutral. But many shippers have been left without many details, but perhaps this could be a good indication that those efforts are working. In fact, we did get some headlines out of some shippers earlier today saying that they are taking President Trump's efforts into account when they are reviewing their security protocols. Also, though, at the same time, the situation really does remain highly, highly fragile. John, as you well know, earlier today, Iranian state media said that the government had, quote, redefined the control zone in the Strait of Hormuz, appearing to say that they are putting out new maps where they are going to keep their own control.
And while they say that, the United States and the Joint Maritime Information Center is saying they have an enhanced security area that they are establishing when it comes to the Strait of Hormuz. Tyler, when we heard from the president, he also talked about positive talks underway between Iran and the United States. Where does the diplomatic off-ramp stand today?
Well, Annmarie, as you well know, this White House maintains that diplomacy is still going to be a viable option. Iranian state media did report yesterday that Iran was reviewing a U.S. response to its proposal that it had put on the table last week that could see a reopening of the Strait of Hormuz if the U.S. lifts its naval blockade. But importantly, that plan had laid out that Iran wanted to postpone dialogue when it came to its nuclear program, something this White House says is a non-starter. Now, President Trump, importantly, did say that talks were making progress progress, but he also didn't rule out the potential that we could see further U.S. military strikes, amid reporting that it's something President Trump is seriously considering in a bid to try to get through the gridlock of the negotiations. But Annmarie, at this point, the administration is saying that they are going with the economic pressure instead of resuming that military campaign. We had the U.S. Treasury Secretary Scott Bessent outlining that the U.S. thinks that Iran is coming close when it does come to its oil storage capacity. In fact, Bloomberg News had reported on Saturday that Iran has begun curbing oil production as its storage tanks fill up. But a senior Iranian official says that this is proactive, that they haven't reached that level yet, but they're trying to tweak their operations in a bid not to get to that full capacity.
Tyler, appreciate the update. As always, Tyler Kendall of Bloomberg down in the nation's capital in Washington, D.C. Looking at crude this morning, Brent at the front end of the futures curve, the front month right now, 110 for the month of July on Brent crude, and elevated across the curve. We're out into the 90s right up until December, where we trade this morning at 89.
Might be too high for this administration, especially when the Treasury Secretary is talking about once this conflict is over, maybe before the midterm elections, you can actually see lower gas prices than we are today. We're at $4.45 today. I think what is interesting, this morning we saw tons of whiplash. What I'm taking away from this is not just the president's words. We need to see the words actually put to action. And I think CENTCOM saying that 2 U.S. flagged merchant vessels successfully transited through the Strait of Hormuz is a huge step forward. But the issue, of course, is that ADNOC is coming out and saying that their vessel was targeted. So we might see this be a little bit messy when it comes to that guiding of vessels.
The market is no longer buying the hopium in quite the same way. And I'd say the key date for that was April 17th. When the administration came out and indicated the Strait of Hormuz was going to reopen, you had this big rally in risk, this big drop-off in crude, and then that weekend it didn't open. From then it was a show-me market. And you need to show me a lot more than what we've seen so far.
It's not just words. They want to see action. And that is why it's incredibly important to understand what CENTCOM is actually able to do in terms of guiding vessels through the Strait.
Coming up tomorrow, Jeff Yu of BNY will catch up with Jane Foley of Rabobank, Gil Luria of D.A. Davidson, and Jordan Jackson of JPMorgan from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.